York, I'm Bonnie Quinn.
And from Washington, I'm Kaylee Lyons. We are kicking you off to the closing bell here in the U.S., closing the session today. But of course, Bonnie, starting the month of September, coming off the worst month for the S&P 500 since February, even though August only brought a 1.8% loss and not a lot of gain to start, even though we did have what was earlier being described as a Goldilocks jobs report this morning. The S&P 500 essentially unchanged at the 45.11 level. And we've seen, of course, a whipsawing in yields today. The 10-year yield right now up about 7 basis points at 4.17. The 2-year essentially unchanged at 4.88. And interesting to pay attention to what's going on in commodities as well. Oil north of $85 on WTI, the highest we have seen going back to November of last year, up by about 2.3% on the day.
Well, and you mentioned it, but here's some of the reason why. Solid hiring continuing in the United States, Kaylee. 187,000 jobs created last month. Hundreds of thousands more people, though, started looking for jobs. Underemployment ticked up and wage gains cooled. It all could amount to what could be a welcome picture, though, for the Federal Reserve, looking to hold steady on rates this month and then keep options open, wide open even, for Q4. Yields whipsawing today, plunging after the labour data and then reversing all of those declines and then some, as traders delved deeper into the NFP report and saw strength as well in the ISM manufacturing data, particularly in employment and prices paid. We'll get thoughts from the former New York Fed President Bill Dudley and also the director of the Cornell School of Labour. Chip stocks as well going their separate ways today as the AI narrative carries into September thanks to Dell's results. Intel, the Philly Sox Index leader, Broadcom the laggard. And it's not just chip stocks today. Stocks dependent on the affluent in general, from Lululemon to Toll Brothers, well, they're gaining in stark contrast to the low price point retailers, for example. And Kaylee, you reminded me that it was actually a full day of trading for the bond market today in advance of the Labor Day holiday. Typically it closes at 2 p.m., but I imagine it was very welcome for bond traders out there.
Yeah, there was a lot of data that those traders needed to digest, Bonnie. And initially, it looked like it was a bid into the bond market off the back of payrolls. We saw the 2-year yield, of course, that Fed-sensitive part of the yield curve, drop to the lows of a session as low as 4.75 after the jobs report. Then after the ISM figures you were just mentioning, Bonnie, we saw them go as high as 4.89. Right now, we're at 4.86. But remember, this time last week, we were at 5.07. So we are still down about 20 basis points over the course of the week as this market reprices really what the Federal Reserve is likely to do as it reaches or gets near the end of its hiking cycle. And on that note, Bonnie, in light of all of the different data we have seen today, if you look at the pricing for what the Fed is likely to do this month, in the month of September, there is virtually no chance at all this market sees of a 25 basis point hike. Right now, those odds are down at around 6%.
Well, Kelly, for more market analysis now, we're joined by Nicole Webb, Senior Vice President and Financial Advisor for Wealth Enhancement Group. Nicole, thanks for joining. It's the first day of September and we've had this raft of economic data. What are we supposed to think going into the rest of the month?
You know, our story going into the end of the year, we've actually changed our tune a little bit over the last 2 months. It really feels to us that there is such a massive growth story to really offset the unknown weakness of the consumer in 2024. And I think that's where this narrative is, this ping pong match. And some of the charts you just showed on the 2-year, just intraday today, play into that, where we look at the jobs market, we think one thing, but then you go into the ISM August report and you actually see quoted in their inventories are just too low. And so have we bottomed out in manufacturing? Are we reaccelerating in some of these pockets? And then the spend forward that we anticipate in the AI frenzy across all areas of business at the enterprise level, you know, again, just reaccelerates that growth story. And so for us, we kind of expect more positive months ahead.
Well, you've said something that's a tiny bit concerning. You said that spend forward. Is that what's happening, Nicole? Are companies spending forward in anticipation that perhaps rates are going to stay higher for longer? And does that hurt future quarters?
Our bet is on an increase in productivity. So we saw a massive spend forward in the onset of COVID. That has implications on the backside that we're just starting to see. And so then when we think about the next leg of this, the spend into AI applications, again, we're still, this summer we were at near all-time lows from a productivity metric standpoint. And so forward looking, we do think that that's where a lot of this acceleration and growth will come from, in light of not having as many available workers in certain industries and areas that we're accustomed to seeing.
Okay, so as we talk about where that productivity is going to come from, thinking about AI and technology, of course, it was tech that was the big contributor to the rally we had seen basically up until more recent history, Nicole. Do you think that comes back? Can tech continue to provide leadership in this market?
We actually do think tech will continue to provide leadership in this market through the end of the year. It's like the freight train that is just going to keep going into the end of the year. And that wasn't necessarily our consensus or our bet even 2 months ago. We started to look at the duration pressures around the technology trade, this fundamental belief that the hedge funds just certainly had to pull off some of those gains, lock them in short duration assets, and kind of sit tight through the end of the year. But instead, what we're seeing is NVIDIA is going to sell every chip that it can make. And when we look at Alphabet as another entity, it is the largest media company out there, and we're seeing an acceleration again in digital ad spend. So for all of these reasons, there's just this tailwind behind technology. And there's other sectors too that we think will follow suit. There is the 493 other companies, and we do see some of that broadening starting to happen.
On the subject of broadening, one sector that has largely sat things out is the banks. Even as the story theoretically improved from a fundamental standpoint, the concerns around deposits and the aftermath of bank failures we had seen this year, you haven't really seen the banks able to catch up, to recover from that. Do you think that changes in the near term?
I do. I think that as we move further and further away from this consensus of the recession narrative, when we think about the consumer, it just plays strongly into that's likely a pocket to pick up potential in the coming months. I mean, you look at the JP Morgans of the world, and they're trading at 9 times versus these technology companies, and at the same time offering a 2.6% dividend, which 18 months ago we would have thought was fantastic. And so as we return to normalized expectations in the future, these names are really strong and a little bit unjustly punished for a multitude of reasons.
Are we going to see a bifurcation, Nicole, between sort of the lower price point type stocks and the stocks for consumers that are more affluent, that are more able to afford to spend?
Yes. I mean, we continue to have this conversation around, at a broad level, we talk about the consumer holding in there. But in the day-to-day conversations we have with people, you can't escape the story around how expensive everything is right now. And so, it's not even necessarily high income earners. There's really this concentration of wealth in the baby boomer population. You see that read through in the labor reports. You see that the 55 plus is just not coming back to work. They're a huge portion of that second home purchasing, of kind of this pickup and spend, and they're cash buyers. And quite frankly, higher for longer is good for them because they tend to have a bit of a tilt towards conservative investments. And so they're just not being slowed down. And we're going to continue to see that play through into the names and their performance.
All right, Nicole, thank you so much for your time today. That is Nicole Webb of Wealth Enhancement Group. Coming up, we'll speak with former New York Fed President Bill Dudley about today's U.S. jobs report. Plus
Tesla's $41,000 discount. We'll discuss the revamped Model 3 sedan and the carmaker's push to boost sales.
And Steve Ratner, Willett Advisors Chairman and CEO. His thoughts on the United Auto Workers strike. All of that and much, much more coming up. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. While still of the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
The Mariah is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
This is if you average the last 3 months, it's about 150,000 jobs each month being created. This is the transition from the breakneck speed of the fast recovery we saw initially when President Biden first came into office to the consistent, steady, stable growth that you'd want to see in a strong economy.
That was Acting Labour Secretary Julie Su speaking with Bloomberg earlier. Hiring picked up more than expected in August, while wage growth slowed. Joining us now for more on the jobs data is former New York Fed President and Bloomberg Economics Senior Advisor, also Bloomberg Opinion columnist, Bill Dudley. Bill, thank you so much for joining. How confusing is this report for the FOMC? Is there anything in here that will move the needle on rates or even the SEP?
I think generally they're going to be take reassurance from this report because it does show a slowing in the rate of payrolls when you add in the revisions to the previous 2 months. Also, the size of the workforce has expanded, and that's the reason why the unemployment rate moved up to 3.8%. So more labor supply, slowing payroll growth, and the wage trend in this recent month was also quite subdued at 0.2% for average hourly earnings. So, you know, on balance, they're going to be thinking that this is consistent with the soft landing that they're shooting for. And as a consequence, the markets today basically said they're not going to raise rates in September, almost certainly. And they said in November, the chances of the Fed hiking rates is probably only 1 in 3 at this point. So the markets, I think, interpret the report correctly. The problem is that the economy still has quite a bit of forward momentum. One aspect of the report that was on the stronger side is the total increase in hours worked, which is up 0.4%. And if you look at GDP growth in the third quarter, it looks like it's going to be quite sturdy. The Atlanta Fed GDP Now estimate after this report is 5.6% growth for the third quarter. Now, I don't think growth will be that strong, but it certainly is telling you that economy really hasn't slowed down to any appreciable degree yet. And so there's probably still more work for the Fed to do. Now, I think the Fed's going to do that work mostly by keeping rates higher for longer, emphasizing the longer side rather than the higher side. But it'll be interesting to see what they do in the summary of economic projections, in a couple weeks, because, they last time they said 2 rate hikes, they did one of them. This time, are they going to show one last rate hike, or are they going to say that, we're more confident about a soft landing, and so we don't have to do any more? So I think the next meeting is going to be pretty interesting, not in terms of what they do. They're not going to do anything in terms of rates, but in terms of what they show about what they think they're going to have to do going forward.
If the data continued to come in the way they did this week, and I'm talking not just all of the jobs data, but also the inflation data today and also the ISM manufacturing, quite frankly, is that an economy that would even need another rate hike?
Well, I think it depends on your view of 2 things. Number one, how tight is monetary policy right now? And 2, what are the long and variable lags of monetary policy? Is there still more restraint to be felt from the monetary policy tightening that's already been put in place? I think most FOMC participants view monetary policy as already tight, and that there's still some force of that monetary policy tightening to still be felt on the economy. And so I think I think the case for pausing is increasing. Whether it's enough to carry the day, I mean, it's going to depend on the data between now and the November FOMC meeting.
I'd like to return to your point about higher for longer and this idea of a soft landing, Bill. Theoretically, if the landing is soft, if we still are seeing resilience in the labor market and the economy, people are still spending, there is still plenty of demand, doesn't that mean the Fed would be more likely to hike as its next move, even if we do have a long pause for a long period of time? Why in that scenario would they need to start cutting anytime soon?
Well, I think the notion of a soft landing is that we get inflation all the way back to 2% without the Fed causing a recession. So when people talk about soft landing, I don't think they're talking about just continued economic growth. That continued economic growth is just the hard landing deferred. When people are talking about a soft landing, they're basically saying the Fed can pull this off without generating a significant rise in the unemployment rate and without generating a mild recession. And the fact is, the only way that they've been able to pull that off historically is if the unemployment rate doesn't really rise much. Every time the unemployment rate has risen by more than 0.5% since World War II, 12 out of 12 times, we've always had a recession when that's happened. So to believe in a soft landing, you have to believe that the Fed can sort of stabilize the unemployment rate around here, and that's good enough to get inflation all the way back down to 2%. That's what they're hoping for. But that's not what they're actually showing in their own projections. In their own projections, they have the unemployment rate going up to 4.5%.
So what about the belief in the 2% target, Bill? Do you think that is achievable this cycle in this post-COVID world? I know Chairman Powell at Jackson Hole said it is and will remain the target, but really?
Well, obviously, it's going to be harder to do the last mile than the first few miles because a lot of the downward pressure on inflation has been just unwinding the transitory pressures upward on inflation that we saw in goods prices during the pandemic. And as demand has now shifted from goods to services, goods prices are coming down, and that's pulling down inflation. Now we're left with sort of the tough part, right? The part that's really driven by the tightness of the labor market and the fact that wage gains are not consistent with 2% inflation. I think the Fed's view is twofold. Number one, we're going to stay the course. So they are committed to getting inflation all the way back down to 2%. And two, it's going to take a while. If you look at the summary of economic projections from June, they didn't see inflation getting back to 2% until 2025.
Bill, is the bond market in any way confused? We've had quite a round trip over the last few sessions from 510 to 474 today it was at one point.
Yeah, I was a little confused by the bond market myself today. I mean, I thought that the bond market would look at this report as sort of benign and, would be reassuring in terms of that the Fed was not going to tighten much further. But I guess the bond market basically took it more as, gee, I guess the Fed's going to not be able to cut very soon, anytime soon, because the economy still has quite a bit of forward momentum. If we keep the federal funds rate at, 5.5% for a while, that's going to weigh on a bond market that's trading, 10-year Treasury note yields are trading, more like, 4.20 or so. So you can sort of imagine that if people extend their horizon of how long rates have to stay high, that will definitely weigh on the bond market over time.
Yep, 10's at 4.17 and the 2-year yield at 4.86 as we speak. Thank you so much for joining us, Bill Dudley, former New York Fed president and, of course, Bloomberg opinion columnist. Now, coming up, we're going to turn to a corporate story. Tesla's latest discounts will qualify one of its models for federal subsidies. We'll have more details on the company's pricing strategy next. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. While I love the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
Tesla has now dropped the starting price of its signature Model X SUV by $41,000 this year. And that makes the car eligible for the federal tax credits revamped by the Inflation Reduction Act. Bloomberg's David Welch joins from our Detroit bureau to explain. So just enough to have them qualify. Will this boost demand massively, David?
Yeah, look, it should give it a real shot in the arm because not only obviously dropping the base price quite a bit, and it has been for all their models a lot over the past year, but then you get another $7,500 for that same customer. And you add that in, and they've actually dropped the price by almost $50,000, including the federal tax cuts this year. That's a huge discount, even for vehicles that we're selling for, with the right battery and the right equipment, $110,000. So yeah, that could absolutely get them a lot of demand, and they kind of have to, because the Model S and the Model X, they're two bigger, more expensive models. They haven't had a refresh, really ever, stylistically. So people have been looking at that same design for a while. And that also, that kind of mid to large sedan, mid to large crossover SUV segment, that's where all the competition's coming in from the Germans, from Ford, from General Motors, and Hyundai, Kia also have vehicles that are kind of, in that configuration, in that market segment. So more competition, some federal spiffs involved, and they're pricing it about right at the moment.
Well, David, what Tesla enjoys that not all of its competition does is much healthier, wider profit margins. How much further realistically could they go on bringing pricing down and still be able to retain that?
Well, they've given up a lot of that, right? I mean, they always had this goal of being at 20% gross margins, and they slipped under that in recent quarters, and they seem pretty okay with it. So I think they're willing to give a little more, but at some point it has to stop, because one of the reasons Tesla has such a high valuation is because of these profits and because they can grow so much. They can get the growth by dropping prices, but they give away the margins. They start to look like any other car company, and I think that could weigh on the shares if they keep doing this. And we don't really see an end in sight, because they do keep trimming here and there.
And for all of those, any other car companies, what do these price cuts mean for competitors? I feel like every time we get one of these headlines that the price of a Tesla has gone down, we raise the price wars question. Do we actually get to that point?
In a way we have, because you are seeing, for example, Ford, they lowered the price of their Mustang Mach-E EV, and they said it was directly because Tesla was dropping prices for competing models. And that whole, you take the Model Y and the Model X, these are crossover SUVs, kind of. I mean, they're not quite SUV looking in the way they're styled, but they have that kind of room inside in terms of cargo and passenger space. Competes directly with most of the models that are out there. So that does put pressure on everybody else when the market leader's doing this. It's just basic economics, but also, Tesla is still the EV brand, despite the fact that new players are coming in. So it will. There are some other areas like pickup trucks that may not, electric pickup trucks may not quite feel that pressure, because there aren't as many competitors out in those segments. But, the whole of the EV market right now is sort of like the vehicles Tesla is selling. Cadillac's Lyriq is kind of a similar configuration to that. They haven't dropped prices yet because they don't have any inventory, but over time they may be pressured to as well as they get production ramped up. And you may see that you haven't seen the Koreans really drop prices yet, but you've seen their sales actually soften up a bit with the models that would compete there. So, we went from a monopoly to an oligopoly, and pretty soon we'll have full competition in those markets, and pricing will soften up.
A brief comment on what it's doing with its cars in China as well, David. It's giving them further distance, really, without having to recharge.
That's right. So the new vehicle's not really a radical stylistic change, but Tesla's all about technology. So longer range on the battery, a big touchscreen in the rear seat. Styling may be a little more sleek, but still kind of looks like pretty much the same vehicle. But it's all about the battery and technology with Tesla. And that's what they're going to be pushing. And they did raise prices on that vehicle, so they're hoping that the longer battery range is going to command that sticker.
All right, David, thank you so much. Well, right now, investors are reacting by sending the stock lower by 6%. That's David Welsh. Thank you in Detroit. More next. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
This is Bloomberg Markets, the close. Let's get a cross-asset check as we head towards the close of commodities markets. Well, we've seen a nice rally for oil, staying above $85 a barrel now as those OPEC cuts kick in. 85.58 today. And that, of course, gave a big boost to many of the oil companies, Valero, Marathon, Freeport, McMoran, and so on. Look at that, natural gas futures. They've had quite the ride over the last number of days. Well, the Baker Hughes rig count just came out, down 1. They had been down 10 the previous week, so it could be that those rigs are bottoming out finally, and that we shall see impacts of that, and also, of course, the potential for strikes in Australia play out in the natural gas market over the course of September. And copper as well, perhaps on the data out of China, up about 0.9% on that 3-month rolling contract right there. Very much worth keeping an eye on Dr. Copper. Kaylee.
Absolutely. When we think about the Chinese data and also all of the steps that China is taking to stimulate its economy and try to support its currency. For more on this, Tom Orlik, Bloomberg Economics chief economist, is joining us now. Tom, it seems like every single day this week it has been something new, whether it's the FX reserve ratio or cutting mortgage rates, trying to shore up the stock market by taking action on IPOs and the like. Does all of it add up to enough? And I wonder if that is what is reflected in commodities markets as you see oil at its highest since November of last year and iron ore as well at the highest since April.
So let's be clear, Kaylee. The situation facing China's economy remains pretty dire. They've still got a huge problem with the real estate sector, where there has been much too much building and much too much accumulation of debt. But against that pretty bleak backdrop, the week we've just been through was actually a pretty good week. We had some decent data. The PMI numbers provide the first early indicator of what's going on in the economy in August. They were pretty robust, suggesting manufacturing maybe is starting to bottom out. And as you mentioned, we've had this drip of stimulus measures. Now, on their own, these are all micro moves, encouraging the banks to cut mortgage rates, freeing up some dollar liquidity to give a boost to the yuan. But when you start adding them up, it's still not big bang stimulus, but it's starting to look a little bit more substantial. And I think that's what the markets are reacting to.
Well, Tom, to your point, it isn't a bazooka. And I just wonder if the reason why we aren't seeing a bazooka type move from China is because they are unable to do something like really just rescue the property sector, which, as you say, is quite troubled, or they're just unwilling?
So I think the challenge, Kaylee, is that in China right now, the stimulus solution would provide a short-term boost to growth, but at the expense of making the structural problems that they're facing that much more severe. And that's just not a path that Beijing wants to go down. They don't want to juice the property sector again, only to add to the problem of overcapacity, add to the problem of debt, and face a bigger day of reckoning sometime down the road. That's why you're seeing this kind of drip approach, right? 15 basis points of rate cuts by the PBOC, a move by the PBOC to encourage the banks to reduce mortgage rates, a move to reduce down payment requirements. What they're aiming at is a kind of just enough stimulus, right? Just enough to turn a collapse into a managed slowdown, but not too much so they reignite an unsustainable boom.
So, Tom, those numbers you were talking about, the exciting PMIs, where did that come from? Because it seemed like China was in a pretty dire situation. And yes, we had small moves, mainly sort of on the monetary policy side. Did that really trickle down that quickly to the consumer, such that they were suddenly spending on services again and manufacturing was picking up?
So it's interesting, Vonnie. China's got 2 PMI indexes. You've got the official National Bureau of Statistics, PMI. That's got a pretty big sample behind it. You've got a lot of companies feeding into that survey. Then you've got the Caixin PMI, which provides more perspective on small businesses and private firms and exporters and has a smaller sample. So we're kind of seeing the same story from both surveys. We're seeing a story in August about a Chinese economy which is still weak, but at least things have stopped getting worse. The Caixin PMI had that little pop in it, as you suggest. We're kind of fading the significance of that because it is a small survey and so a little bit more volatile.
And then, of course, there's the support for the yuan, Tom. How long can China keep this going? How long should it keep it going, given that it's a little bit artificial?
So it's interesting, Vonnie. In the past, if you saw yuan depreciation, it would really be a kind of panic signal on China. Think about 2015, 2016, where you saw the yuan dropping and people thought, goodness me, is this the kind of the balance of payments crisis for China arriving? But what's happened more recently is the PBOC has engineered some changes in the way they manage the exchange rate. And what that now means is that they can allow yuan depreciation at moments of weakness to provide a bit of a boost to growth, a bit of a boost to export competitiveness. What they don't want to see, though, is one-way bets and excess pessimism triggering a sudden collapse in the currency and massive capital outflows. So I think what we're going to see in the weeks and months ahead is continued yuan weakness. We're going to see the yuan continuing to trend down. The Fed has got high rates. The PBOC is cutting rates. That's a natural pressure for yuan depreciation. But the PBOC is still in the market, providing a little bit of a stronger guiding hand than normal to prevent yuan weakness sagging into yuan collapse.
All right, Tom Orlik, Bloomberg Economics chief economist. Always great to get your thoughts on the second largest economy in the world. Thank you very much. We appreciate it. Now, still ahead, strong fighters can handle body blows. That's what an analyst at Wolf Research is saying about a deal between a Saudi Arabian wealth fund and the Professional Fighters League. Next, we'll have more on how this move will impact the WWE and the sport as a whole. This is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
Time now for our top calls. Let's look at some of the biggest movers on the back of analyst recommendations. First up, Dollar General hit with a wave of downgrades after it's cut its profit forecast. But let's focus on one from Evercore ISI. The analyst saying that the discount retailer has become a show-me story and is warning investors to heed and have patience until traffic manages to stabilize. For that reason, the stock was downgraded to inline from outperform. And as you can see, shares are down another 6.3% today after getting whacked yesterday. Next, Papa John's. Wedbush raising the pizza chain to outperform from neutral. Price target also getting a boost to about $95, up from $80. Same-store sales growth in North America seems to be trending above consensus, and the firm expects Papa John's to deliver strong operating margins in the medium to long term. Shares of Papa John's up 1.7% on a day where, don't forget, indices are not doing all that much. And finally, World Wrestling Entertainment, WWE. Wolf Research reiterating its outperform rating on the shares after a Saudi Arabian wealth fund obtained minority stake in the Professional Fighters League, or the PFL. The analyst views the deal as a new negative for WWE's valuation. Shares of WWE, though, well, they're fighting back. They're up 6.3%. And those are some of today's top calls. Now, the analyst behind that particular call joins us, Peter Supino, senior analyst covering media, cable and telecom at Wolf Research. So it's a little bit of a battle here being set up, Peter. What makes you think that WWE will not just survive but thrive?
Well, thematically, we have been and remain excited about the idea that the best intellectual property on the planet, and especially live entertainment and especially professional sports, really represent a toll booth on global consumer discretionary spending, and that the explosion of digital media, the internet in particular, really is a leverage point that favors the owners of that IP. And so we're bullish on the whole asset class, and WWE in particular is a very differentiated asset, very profitable business that over time has steadily appreciated in value. We think the wind continues to be at their back.
Peter, I feel like when we hear about Saudi money in sports, at least my mind immediately goes to golf and what we saw go down with the PGA in Live and how that was just like a battle royale until they surprised everyone by trying to come together. Would it be the same kind of competition where one is stealing talent from the other, for example, and it really is like that, or is this different?
This morning we wrote that the answer to that question is about the world that we are in versus the world we hypothetically could be in. The transaction that took place recently between the People's Investment Fund of Saudi Arabia and the PFL Wrestling League was a 20%, rather $100 million non-controlling equity stake. We think that bought the Saudis about 20% of the PFL. What that means is that the Saudis do not have control of strategy nor of budget at PFL. And a team of American entrepreneurs who created it in 2018 and who've raised money from some very credible, down the middle of the road institutions are making the budgetary decisions. And that doesn't sound to us like analogous to Live Golf, where the Saudi government controlled the strategy and the capital allocation. Now, the world we could find ourselves in the future, if things go a certain way and a chain of events plays out poorly for WWE and UFC, is that the Saudis get control of more than 51% and treat this as an investment platform without much sensitivity for returns. And that's just not where we are.
Right. Explain how this all happened, because remember during COVID, didn't the Saudis provide a bubble for the mixed martial arts world, which teamed up with WWE, and Ari Emanuel had managed to sort of make the whole thing happen, and now suddenly the Saudis are not so involved? Just explain the backstory there, Peter.
Sure. The Saudis have spent about $6 billion on sports rights in the last several years. That's a third-party estimate on sports investments and sports rights. That includes Live Golf. It includes their soccer team. It includes the soccer league that they've just created, and a number of other things. And one of those other things is that they have they're home to two major WWE events every year that produce about $100 million of revenue for WWE. UFC and Ari Emanuel have a different history with Saudi Arabia. The Saudi government was a large investor with Ari Emanuel, and after the Jamal Khashoggi events, tragedy, however you want to call it, Ari sent the equity capital back to Saudi Arabia and is not presently in business with them.
And finally, Peter, especially given we are on a big economic data day here in the U.S., we got the jobs report. Signs are still pointing to resilience in the economy. If things do start to turn, though, when we're thinking about the experience economy and people spending money on things like live entertainment, does that leave names like this vulnerable, or are they recession resistant?
We look at the services as a percentage of consumer spending and also live entertainment as a percentage of that statistic, and both of them are below their prior peak levels. And all that says is the demand in this space isn't overheated. Having said that, there is a discretionary component to this. And so if you are managing a portfolio and trying to reduce your exposure to consumer discretionary, then certainly you need to forecast this business with sensitivity to that. Having said that, WWE in particular tends to trade as a non-cyclical business in the public markets, because despite that there are gate revenues and concession revenues and advertising revenues, the bulk of the revenues are locked in. They're TV media rights distribution deals that are not cyclical at all.
It really is a phenomenal sport, and phenomenal to watch the lines building outside when there's an event happening all over the country as well in the United States. Peter, thank you so much. A fascinating read. Peter Supino over at Wolf Research, and he has a price target now of $137. on WW, which is a 41.9% upside from where we are right now, or from where his previous price target was. Coming up, we're going to be hearing from Steve Ratner, Willett Advisors Chairman and CEO, about his concerns on the looming UAW strike. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
Let's turn now to our Wall Street Week Daily segment. Steve Ratner, Willett Advisors Chairman and CEO, sat down with Bloomberg's David Weston to discuss the United Auto Workers complaint filed against several large U.S. automakers. Take a listen.
This is really a scary situation. We've had many labor negotiations between the auto workers and the UAW over the decades. We've had some strikes, unfortunately, but some of them probably were inevitable or even perhaps necessary. This situation is really scary for a number of reasons. First, you have a very activist new UAW leader who I do not know personally, but who has said very inflammatory things, didn't do the traditional GM or auto worker initial handshake, which is just symbolic. He doesn't have to do that. But more importantly, has put out a set of demands publicly, which is unusual in itself, that are in utter laundry lists from everything from a 32-hour week to a 4-hour week to more holidays to more job restrictions to a restoration of defined benefit pensions, just a long list of stuff that is just beyond the pale in terms of any auto company's ability to meet it.
Now, one of the things that Sean Fain, I guess is the name of the head of the UAW, has said is they need to make up for some lost time. There has been a lot of inflation, as we know. They were operating under a labor contract that really didn't allow that inflation to be taken into account. Can you separate out what is truly making up for lost time, catching up with where they should be, maybe advancing a bit, as opposed to fundamentally changing the business model for the auto companies?
Well, I think that when you talk about asking for pay increases, and they've asked for very large pay increases as well, that sort of falls into the making up for lost time category. Although I would acknowledge that, or I would note that they did get fairly substantial profit sharing bonuses as a result of the auto companies being more profitable. They have had wage increases and so on. So it's not like they took massive pay cuts in recent years during this inflationary period. But the bigger thing of concern to me is everything around the actual pay level. And it includes things like the number of hours worked, when overtime kicks in, how many holidays you get, how many personal days off you get, things like that. But here's, David, the thing that is the scariest of all to me, which is work rules. I am a great believer in unions. I'm a great believer in the right and the ability of unions to bargain for higher compensation and for certain kinds of other benefits, healthcare, things like that, that we all know are important now for workers to have. But when you start talking about work rules, then you start cutting into productivity. And then we start going down a slippery slope we've been down before with bad effects. When we got involved with the auto sector, and in General Motors in particular, I remember, there were something like 300 job classifications at General Motors. If you were an electrician, you couldn't touch a piece of plumbing. If you were a truck guy, you couldn't do something else, and so on and so forth. And it makes for a highly inefficient production process and works to the detriment ultimately of everybody. And the unions have come back now and asked for the reinstitution of some, happily not all, of the kinds of work rules that we had before 2009. And that kind of rolling back of this sort of wholesale rolling back of the clock is a very dangerous place to be. So, but let me say one other thing. In terms of all of these wage settlements and negotiations that you see going on, whether it's UPS, whether it's the auto industry, whether it's whatever, you have to really separate in a way, and I know this doesn't sound necessarily completely fair, but you have to separate the so-called tradable sectors from the untradeable, non-tradable sectors like services. Paying the UPS workers more absolutely contributes to inflation. It affects every American who ships something by UPS and obviously benefits the UPS workers. Doing something similar in a tradable sector, by which we generally mean goods that can be traded across borders, you do run into international competitive issues. And this was part of what ailed the industry back in 2009. The yin and the yang of this is if you raise wages too much, then production will flow somewhere else, most notably to Mexico, which has had a disproportionate share of production increases in the last 15 years. Or it will flow from the north, from the unionized plants in the north, to the non-unionized plants in the south that are operated by a lot of the foreign companies that are coming here. And that does save jobs in America, but they're much less remunerative jobs, and they're located in places in the country that perhaps don't even need the jobs as much. So there's a lot of complexities to what is a fair and appropriate level of wages once you start getting into these tradable sectors.
Steve, as you lay out, there's a dynamic in this negotiation, a lot of concern about whether they can actually bridge the gap. But this all comes against a backdrop of larger changes afoot in the electric vehicles. And that's showing up, as I understand it, already in some of, for example, the battery plants with some joint ventures where I think the UAW is saying, wait a second, they should all be subject to UAW as well. How big a problem is that as the auto industry looks, both workers and employers look forward to a very different world with electric vehicles?
Yeah, that's definitely a complicating factor. Electric electric cars in general, require few man hours of labor to make, as I'm sure you know, fewer moving parts and so forth. And so in the long run, it does raise the question of the level and extent of auto jobs that we're going to need in this country or anywhere else for that matter. It's not all going to be done by robots, don't get me wrong, but is there going to be some cap or some lessening of the number of jobs we need?
Steve Radner there of Willett Advisors, Chairman and CEO of the company, which invests the philanthropic and personal assets of Michael Bloomberg, our founder and majority shareholder. And as a reminder, Wall Street Week is tonight at 8 p.m. Eastern and throughout the weekend on Bloomberg Television. Still ahead on the close, we'll have more on the markets. We're going to be speaking with plenty of people about these directionless markets this first day in September. We now have the Dow up 0.2%. The Dow waking up after a long slumber, it would seem. The S&P is going absolutely nowhere. Yields took a long journey and they're back where they were. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. While still of the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
This is the countdown to the close. I'm Vonnie Quinn.
And I'm Kaylee Lines.
And let's get a quick check on markets. This first trading day in September, a very exciting day because it's also non-farm payrolls day. And we got a nice build in jobs, but we also got enough negative news potentially for the Fed to be able to rest and to pause on interest rates in September with no conscience whatsoever. That said, even though there's a lot going on beneath the surface, actually on an index level, there isn't that much happening. The S&P 500, as you can see, just up a couple of points. We have the NASDAQ turned around now, the NASDAQ 100, which includes, of course, the banks, which haven't had a great week, down about 1/4%. We have the KBW Bank Index, right, as I said it, up 1.1%, so completely contradicting me, although it's true about the week that they've had. And then the two-year yield at 4.86%, as if nothing had happened, as if it hadn't been down at 4.75% earlier on at all, Kaylee.
Yeah, Vonnie, really interesting to see the moves that we have seen across asset classes today, but some moves on some individual stocks as well that are worth noting. One of them being Warner Brothers Discovery. This stock is down nearly 13%, heading for its worst day since November of last year. And it's really just getting caught up in the fallout of a story related to other companies. Disney failing to reach a new distribution agreement with Charter Communications. And analysts are actually saying that that is a negative for all of media. KeyBank saying they're losing negotiating leverage with their distributors. So that suggests pricing pressure really across the board. Hence why you're seeing the drag on Warner Brothers Discovery today. But a headline just crossing the terminal, Vonnie, Disney says it's ready to get back to the negotiation table with Charter. So I guess we'll see if that means a different result could come.
Yeah, but I mean, that is a massive drop for Warner Brothers. And it also was in Barron's this morning, not just everything you've been mentioning, but how is the embattled media conglomerate organized and how can it grow? And, you know, we've been talking about a new head for CNN and one coming from the New York Times and so on. But really, that's the very, very micro when it comes to a big company like this. And shareholders are a little impatient.
Yeah, it seems so. Other shareholders that might be getting impatient or just not like what they're seeing, those holding Tesla. This stock down 5.5%. And Vonnie, once again, we're talking about price cuts on vehicles, the Model S and the Model X in both the U.S. and China. Tesla's now charging just $74,990 for that base Model S. And of course, that's about getting those tax breaks through the Inflation Reduction Act. But what that means is profit margins could get crimped.
Yeah, isn't it fascinating? I mean, it's a lot of money still, you know, nearly $80,000 for a vehicle, albeit a nice vehicle perhaps, but that drop is pretty substantial. I mean, you're talking about, you know, 50% from where it was. I mean, it's really quite outstanding, and you can imagine that it's no wonder shareholders are sending that stock down, but let's not forget it's up 100% year to date.
Yeah, and there's other stocks that are up. Maybe not that much year to date, but certainly up on the day, Vonnie. Let's get to one upside mover. Lululemon up 6.5% after earnings, raised its full year outlook. And it is interesting to see a company like this defying what we're seeing in other retailers that aren't necessarily doing so well, dealing with a slump. It really reinforces this idea that the higher end consumer, especially brand loyal higher end consumers, are still out there spending on brands like this. And I guess a lot of people still want to wear athleisure.
Exactly, and we might see more of that bifurcation as we go forward with many more people joining the labour market, Kaylee. Well, let's get more market analysis now from Melissa Brown, Contigo Managing Director of Applied Research. Melissa, first your thoughts on today's, I guess, moderate jobs report?
Well, you know, I think as you mentioned, the news that came out of the jobs report was mixed. There was some good news in it, and there was some maybe less good news in it. And so, you know, you've got the buyers against the sellers. And so it's not so surprising to see that not much is happening, particularly in the equity markets.
What does it mean, though, for the U.S. economy? Does it mean that the Fed has the perfect right now to pause for some time? And what will it mean for the following meeting?
You know, I think we're going to still have to wait and see what the next inflation print is. The corporate profits coming up in a relatively short time, and see what the impact of inflation has been on profits, and you know, the impact of higher rates on companies' ability to finance. So I don't think there's a clear answer yet based just on this jobs report.
Okay, so given that we do have this lack of clarity in many different ways, Melissa, what should I make of a VIX with a 13 handle, of the lack of volatility and fear that is out there given all of that uncertainty?
It really is very interesting to see how low volatility is, whether you measure it by the VIX or measure it by models that we use as well. It's very low. It's kind of in the bottom third relative to where it's been over the past 40 or so years for measures of volatility. And, I think there are a few things going on there. One is that perhaps investors don't really know what to do, so they're not doing much of anything. I think that's one thing. I think also when you look at volatility of an index, though, you have, these few, the Magnificent Seven or, relatively few stocks that are driving the index higher. So there's actually volatility going on under the surface. But our big concern about the low level of volatility is that it's giving investors a false sense of security. And we're seeing evidence that there's not as much hedging going on as perhaps there was a year ago. And if something happens and investors have to either cover whatever short positions they have, or they need to sell, and they might sell these Magnificent Seven because that's where they have gains already. When you couple that with high levels of valuation, so the PE on the market is roughly 20, I think that could portend a bigger move down in the market than we might otherwise see.
And when do you think that might come, Melissa? We are coming off the worst week or the worst month for the S&P 500 since February, even if that month only brought a decline of 1.8%. September isn't usually all that great for equity markets. Do you think this is a near-term scenario that we see this downside actually potentially come to fruition?
I think for many reasons it could be more near term than longer term. There's an old saying, buy on the rumor, sell on the news, and we really have gotten the news now. I think investors have been discounting the relatively good news on employment or lower inflation for a while now. So, that's one possibility. As you mentioned, September, historically, at least over the past 40 years, is the worst month of the year for equities. I know we all like to focus on October because there have been some big events in October, but actually September is the only month on average where returns have been negative. I'm reluctant to pick a specific time that we might see something happen, but it's certainly, I wouldn't be overly surprised if we did see a sharp decline in September.
Melissa, is AI an overcrowded trade?
It may, I think what we're seeing now is it is a crowded trade, but it's a crowded trade that's still being rewarded. So we're seeing that, our measures of crowding actually have produced very positive returns up till now. The problem is if it's overcrowded and investors feel the need, something happens that they feel the need to exit that trade. And then, you've got a lot more investors coming out of that trade. So right now, it probably is crowded, but that's fine. But we'll have to see what happens when there's some catalyst that brings the market down, and that may cause a problem, the crowding in that sector.
Yeah, and of course, it is the frenzy around AI that has brought multiples for a lot of these tech stocks to the elevated levels at which they now are. Where do you see the biggest vulnerability from a valuation standpoint? Is it technology, or are there other pockets that you're wary of?
We do see, you're right, that, technology's valuations are quite high, but I think I don't see any sectors where we're looking at low valuations or cheap stocks. We have seen, many stocks go up, not up as much as the market, but they have gone up. Their valuations are starting to get rich at a time when profits are coming down. So we've seen 3 quarters in a row of profit growth, either slowing down or turning negative. And so, I think there's, kind of a across the board valuation issue.
Melissa, thank you so much for joining us today. We will be chatting to you again before all of that happens, hopefully. Melissa Brown of Contigo. Meanwhile, the amount of cash flowing into U.S. money market mutual funds is said to be the most in a decade. For more on that, we're joined by Bloomberg's chief global macro markets correspondent, Liz Capel-McCormick. Liz, thanks so much for joining. Just give us the state of play. Just how much money is going into this asset class, and where is the money coming from?
Well, right now there's about 5.6 trillion sitting in U.S. money market mutual funds. So that's a lot of money. And like you said, it's on course. If it keeps this pace all year, the folks from JP Morgan were flagging that it'll be the biggest annual inflow in more than a decade. I was looking at the ICI money fund data. It's even back to like 2002, I can't find a year that was bigger if it keeps this pace and grows. But where's the money coming from? Well, I mean, with yields at above 5%, people are saying, why should I take risk? Let me just park my money. Some of it is just better yields than bank accounts, yielding maybe 50 basis points. Some is after the March mini bank crisis, people are feeling like, I want some more safety. And just kind of feeling like, why, like I said, why take risks? Even 2-year bond yields are lower than money market funds. So there's a lot of people saying it's a kind of, I'm getting paid to just be safe and wait and see how things pan out.
Yeah, exactly. And Liz, are they sort of generic? Are they a commoditized product out there right now? Who's doing better than whom?
Well, no, I think it's now the funds themselves would disagree with me, but I think for the big players, we all know who they are, these big fund companies. If you look at like a standard government-only money fund that is not buying things like commercial paper and stuff, they're all about the same. And then we have prime funds, which have a little bit more risk, but not a lot compared to stocks and things. So you have commercial paper and things like that. But yeah, it's pretty, I mean, everyone has their fund companies they like the best, but I think it's pretty generic. I don't think you have to be a rocket scientist to kind of do well and say, let me, pick a big fund company that has a mutual fund and just park my money in it. I'm making about 5%, and I'm good. So I don't think it's particular to one company better than another.
And if this dynamic keeps going, if this money just stays parked in money market funds, what are the implications for liquidity, Liz?
Well, yeah, that's the thing, right? Liquidity is always a question. One thing is you could think about it, Kaylee, like there's all that money, people are waiting, as far as let's think about stocks, which have done surprisingly really well this year, and many people didn't think they would, that if it gets to be like, oh, are we really for sure going to have this soft landing and inflation keeps coming down more and we're into next year and the Fed starts to slowly ease rates? I think you have a lot of those people who have done well sitting in money market funds will maybe add liquidity to some of more of the riskier markets, right? But you always have to worry, does everyone, move on a dime, right? So we don't know. But right now there is a lot of ample liquidity sitting, waiting to be deployed in other places for now.
And Liz, finally, just on the subject of liquidity, I feel like we can't have you join us today and not ask your thoughts on what we've seen take place in the bond market, this whipsawing we have seen in yields. Should we attribute that to just relatively low liquidity, considering it is the Friday before the Labor Day holiday, or is the data really just that confusing to this bond market?
I think you have to chalk up a lot of this to liquidity. Yes, we did have like a mixed number, so it seemed good and then maybe not. And the manufacturing number was strong. So you could give it some reasons, but it's the Friday before Labor Day weekend. A lot of people want to scoot out early. So I really think a lot of this, and people were warning ahead of it, like be ready for some wild swings. It's a low liquidity day. I think that's part of it. It might be like this for a while, that every darn number I want to say is a live number, right? Because the Fed is data dependent. But I think today is a little bit of a holiday illiquidity exacerbating the moves.
Yeah. All right. Well, you and I are here working on this holiday, even if not all the traders out there are. So thank you very much for joining us. Enjoy the Labor Day weekend. Bloomberg's Liz McCormick. Now, coming up, we're going to turn away from stocks and bonds, and we're going to go to crypto. Is this the end of NFTs? Once touted as the next big things, non-fungible tokens are facing their worst moment, Bonnie.
Yeah, exactly, Kaylee. Plus, we'll discuss the effect of strikes on the labour market with Art Wheaton, Cornell University School of Labour Studies Director.
And we'll count you down to the closing bell with Jason Pride, Private Wealth CIO at Glenmead. All that and more coming up. This is Bloomberg.
today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
A fascinating story today. It is a little bit about the chips, it is a little about the consumer, and is a little about that jobs report today. Let's have a look at some of the movers. Look at Exxon and Chevron. We had oil above $85 a barrel and staying there. Also, LNG was high today as well, and that's helping all of those producers. Intel's Pat Gelsinger has a feeling that things are getting better, and that was enough to send that stock up 4%. But bear in mind, we did have some chip stocks reporting earlier in the week, and Dell also up something like 25% at one point today because it looks like things are turning around in the PC market. So that, of course, is helping the likes of Intel as well. The consumer helping Visa, AMD, another chip stock that's up about 4%. And of course, Apple has such a weighting that even that 0.5% in that stock is helping the S&P overall. Now, if you looked at these maps, you might think that the S&P was doing something. It's really not doing much of anything, and that's probably mostly because of the data today and everything balancing itself out. Because if you look at the down shares, you're going to see a lot of media companies, a lot of telecommunications companies, mostly on individual stories. Kaylee, you were talking earlier about the Warner Brothers story, the Disney story, of course, another one of those stories that we really have to keep an eye on. It's going to take months, maybe even years to play out, but for today, Disney is getting punished to the tune of about 2%. And Nvidia, well, can't really complain that Nvidia is down about 1.5% after the year that it's had. And certainly the analysts we've spoken to have said this is not necessarily the end of the AI story. It's just that it's September 1st and Nvidia is down 1.5%.
All right, so a lot going on in stock land, Vani, but let's talk about what's going on in crypto land as well. The SEC has delayed its ruling on a number of Bitcoin spot ETF applications. And this is coming as the crypto products from NFTs to stablecoins are struggling to maintain their value. Bloomberg's Olga Karif is joining us now to discuss. So, Olga, we'll get to what's going on with the spot ETFs or the lack thereof of stuff going on with the spot ETFs in just a moment. But of course, that optimism is what has supported the prices of cryptocurrencies in particular. You aren't necessarily seeing that same support, though, for prices of NFTs. Just how bad are things out there in the non-fungible token market?
So NFTs, of course, about a year and a half ago, they were like the latest and the greatest thing. But since then, essentially, trading volumes and values of NFT collections have tumbled, in high double digits. And there's no end in sight. And this last month, we saw several NFT marketplaces closing. Some collectors are selling chunks of their collections. So this is a particular corner of crypto that's really suffering, even though I would say that cryptocurrencies as a whole have stabilized. And of course, Bitcoin is up almost 60% for the year.
And of course, in crypto, we often talk about the SEC and enforcement actions taken against a number of different crypto players. Are we seeing that kind of regulatory overhang on NFTs as well?
So absolutely. Just on Monday, the SEC had its first enforcement action against a company that essentially issued NFTs. And in that case, the SEC called the NFTs unregistered securities. So we still have to see if they go after other NFT ecosystem players, but this is certainly a sign, one of many coming from the SEC over many months, that perhaps some NFTs could be seen as unregistered securities.
Olga, there's a great line in your story that I have to quote. Leading NFT marketplace Blur has seen its sales volume measured in Ether drop 96% between a late June peak and early August from doing analytics data. Can you short the NFT market? Has anyone done that?
So the NFT market does have sort of an element of lending, borrowing connected with it. So Blur, for instance, has the Blend marketplace where people could essentially use their NFTs and can use their NFTs as collateral for loans. And the incentive for all of the activity on Blend and on Blur itself has been this Blur token, which essentially, if you mass sort of trade or lend or borrow on this marketplaces, then you get more of this Blur token. But it tumbled a lot, I think 30% just in the last month. So that incentive has disappeared, and so that's why trading on Blur is down so much.
It's a fantastic story, Olga, and the intersection of hedge funds and crypto and NFTs and luxury and all of that all in one. I would urge everybody to read the story by Olga Karif and James Tarmy on the Bloomberg today. And our thanks to Olga Karif. This is Bloomberg. Stay with us. More markets next.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
Well, summer is coming to a close, Vonnie, and Wall Street is cracking down on work from home. More than 3 years from the start of the pandemic, most banks are still working on cajoling staffers back to the office. Many of them are requiring them in person at least 3 days a week. Bank of America, Citi, Barclays, JP Morgan, to name a few. But then if you're more advanced managing director, for example, you might have to be in 5, and that's what Goldman wants of everybody. Vonnie, whenever we talk about these return to work stories, I feel a little not sympathetic because you and I have to be in the office literally every day, but more of Wall Street is having to do the same.
Yeah, no, it's so fascinating, really, Kaylee, and it's coming at a time when COVID is almost coming back in a way. It's just that we know how to deal with it now, and so it's possible to isolate and then come back into the office, and COVID doesn't need to be a thing where everybody just gets to leave the office and not come back. But I think you put your finger on it. Revenue generators have been coming in for some time. I'd like to count us among those revenue generators, but for the banks in particular, those revenue generators have been coming in. I'm actually amazed that there are some banks that are allowing a 3-day work week.
Yeah, we'll see how long that lasts. I just love the quote from Jamie Dimon in The Economist earlier this summer. I understand why someone doesn't want to commute an hour and a half every day. Totally got it. Doesn't mean they have to have a job here either.
This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. Aon has expert points of view on volatility from around the world, paired with local insights that help me get back on solid ground. Better decisions. Aon.
We have about a whole hour left in the trading day, and what a fascinating trading day for the 1st of September. Obviously, next week is a holiday-shortened week, so you might have thought people were going to get an extra day of vacation in, but absolutely not. We had the jobs data this morning, and that showed a lot. It showed that hundreds of thousands of more people are trying to get into the workforce. Is interesting in itself. Also showed wages down just that little bit. So lots of signals coming out of there. And then, of course, plenty of micro moves as well within the market itself. So let's have a look at a few of these moves. Kaylee?
Yeah, let's take a look at those sectors, Bonnie, because as you say, it's been kind of an interesting day. You had jobs data digest, ISM data as well, and where that leaves the equity market on a headline level is not changed too much. The S&P 500 right now is only up by about 0.1%, but there is a much greater divergence beneath the surface, much more activity. The energy sector, far and away the leader today, up more than 2% as we see oil back above $85 a barrel for the first time since November of last year. Some other cyclicals, materials, financials, industrials also on the leaderboard here. While the laggards, interestingly, are consumer stocks. Even though we are still seeing a labor market that seems to be hanging in there, those stocks not doing well today. It's discretionary at the bottom, down 0.7%. Consumer staples down by just about that much as well, Bonnie.
Yeah, and I picked out just a few of those, and in this case, Walgreens, it's not exactly for those reasons, Kaylee. It's more because there was an abrupt departure of a CEO, and that's what has that stock lower by nearly 7% today. So the moves that we're seeing are big. They're small on the index level, but big within that. And Illumina, that's a CEO story as well, but it is up 1.7%. Looks like the biotech company might be finally getting around to actually picking a new CEO, and obviously it had been targeted by an activist, and it's a very interesting company, works in drug research for cancers and so on. And then Freeport-McMoRan, you mentioned it, you mentioned the oil story, the natural gas story as well. That has Freeport-McMoRan, Valero, and many of the companies in the energy patch higher today. And then finally, you got to give a shout out to Dell Technologies, up 21%. Apparently, the PC stalling is over, and we don't have to worry about that anymore. Intel getting a little bump off the back of that as well. Pat Gelsinger says he has a feeling that things are improving. I did want to point out, though, the participation rate. This is an interesting one, and particularly in the context of our next guest, Kaylee, because we can see that the participation rate dropped substantially during the pandemic for obvious reasons, but it also took a long time to start picking up again. And as you can see, it sort of stagnated there for a long, long time. And people were questioning, why is this? Why are people not participating more in the labour market, especially given that jobs are plentiful? Well, we got a little bit of a surprise. It turns out hundreds of thousands of more people did start looking for a job just in the last month. That participation rate ticked up in this labour market report. It's now at 62.8.
Well, Vonnie, it's really interesting to contrast the idea that more people are trying to enter the workforce as some are threatening to sit out work. This summer has been rife with labor disputes across a broad range of sectors. New Jersey transit operators are the latest group to authorize a strike. Meanwhile, U.S. officials are voicing concerns as talks stall between auto workers and Detroit's Big Three. Here's what Acting Labor Secretary Julie Su had to tell Bloomberg about that.
We remain hopeful that the parties will resolve their issues. We trust their process to do that. Obviously, strike is a part of that too, and everybody would love to see a path forward where the union and the employers do the right thing. These are a moment in which union members are seeing historic profits coming out from a pandemic. So I think that the parties have to remain talking.
So let's get more insight on this now from Art Wheaton, Director of Labor Studies at Cornell University School of Industrial and Labor Relations. Art, thank you very much for being with us as we look ahead to less than 2 weeks from now, this contract expiring on September 14th. When you look at the demands from the UAW, 46% hike in pay, a 32-hour work week. They themselves have described these as audacious requests. Does this look like to a group to you that wants to go on strike? Where do you put the odds of that?
I think the odds are different depending on which company you're talking about. So I think the odds of a strike at Stellantis are extremely high. I think the odds at Ford are lower, and GM is somewhere in between. I think they would love to avoid a strike if they can get great contracts. The UAW's proposals say record profits equal record contracts. So they are trying to be very bold in their arguments.
Yeah, and of course, some of this is unique to the auto sector. It's about the EV transition and the role of workers in that. But some of this also theoretically is reflective of what we're seeing across the country, be it the writers and actors in Hollywood, UPS, which was narrowly able to avoid a strike with the Teamsters, flight attendants unions that have voted to authorize a strike as well. What do you think this moment in time for the labor movement is actually a product of?
I think you've been covering it very well here on this channel, talking about that you've had the period of COVID, which had impacted quite a few people and the willingness to go back to work. You've seen a return to the job market or labor market because there's low unemployment and people are seeing that the raises are starting to take effect. So it's worth going into. And now is when labor has more power because there's low unemployment, recently high inflation. They can make bolder demands because the profits have been high. And it's not just in auto. You could say the same thing, whether it's SAG-AFTRA for Hollywood. You could say the same things for Teamsters, for UPS, and all across the board. They're trying to improve wages for the lower tiers, not the highest paid workers in those organizations or companies, but the lower levels to try to bring them up after COVID.
Art, the unions need to get this right? It's never been more important for them if they want to continue on as forces in the labour market in the United States at the very least. They have to ask for a lot. Have the campaigns that you've been studying so far this year, have they succeeded in that?
I think UPS and the Teamsters came out with a great deal. I think they made big improvements, reducing some of the levels of groups coming in, so they had fewer tiers. They made big improvements for health and safety for the drivers, and they have made a lot of changes to try to help everyone in the industry. I think you're still seeing not much progress being made in Hollywood for SAG-AFTRA, but there's optimistic that when demand peaks higher in October with no new shows, that maybe the studios will be more willing to talk and give a fair deal. And I think you're seeing hope in the auto industry. Ford came across with some decent proposals. I wouldn't call them good proposals, but they are trying to make improvements to make things better for workers. And I think that's a good sign for everybody.
Art, if labour leaders could take a sabbatical and come back to your Cornell University's ILR school, what's the one thing you would teach them to do right now in order to strengthen their movement?
I think a lot of the things you're seeing are things that I would have told them directly. So you've seen some unfair labor practice charges from the UAW against General Motors and against Stellantis. And there's big differences in the labor law and whether you go out on strike over money or you go out on strike over an unfair labor practice. So to protect the unions, it's better to go out on an unfair labor practice and use data. So the 46% you quoted from the UAW is exactly what Mary Barra, CEO of General Motors, got in the last 4 years for her raise. So the proposal was, well, gee, Mary Barra, you got 46%. We think all the workers deserve the same. Start with that. That doesn't mean they're going to end up with it, but that's a place to start.
Art, just quickly, we only have about 30 seconds left. I'm here in Washington, where President Biden has described himself as the most pro-union president in American history. Given what we're seeing, is that true?
I don't know if that's true or not. I think you could go back to the Wagner Act and National Labor Relations Act. They've done some great things just after the Great Depression. But I think he's doing a lot of the right things. I think it's difficult for President Biden to be more pro-union without 60 senators to help him pass laws and legislation that would make it more pro-union. So I think he's handicapped by the gridlock in Washington, D.C. to show more pro-union colors.
All right, Art Wheaton, Director of Labor Studies at Cornell University's ILR School. Thank you very much for joining us. Now, coming up, Amgen shares getting a boost after reaching a deal with the FTC on its bid for Horizon Therapeutics. We'll have more on that in our Stock of the Hour. This is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
Time now for our stock of the hour. Shares of biopharmaceutical giant Amgen on the move today after getting the all clear from the FTC to go forward with its $28 billion Horizon Therapeutics takeover. Just a little bit of a reaction there, up about 0.2%. Joining us now to discuss are two of Bloomberg Intelligence's finest, Jennifer Rhee and Mark Engelsgaard. So, Jen, let me start with you. How anticipated was this particular decision, given that, you know, the agencies haven't had it easy recently?
Somewhat anticipated because they slowed down the litigation track about a week ago to talk about settlement. So there was an idea that, you know, this could happen, but it is unusual because this is an FTC that's been aggressive and has sort of disavowed settling over challenging deals. So I think this is a pretty big win by Amgen.
Okay, so Mark, do you see that as a win, given what they had to give to the SEC or the FTC in order to get this through?
Yeah, absolutely. I mean, I think it was pretty easy for them to say, hey, we're not going to bundle either of Horizon's main sellers with any of our existing products. I think they've also agreed to not sort of acquire drugs for thyroid eye disease or gout, which the two Horizon drugs treat. But, you know, I don't think either of those were completely unexpected remedies, if you will, as Amgen made their initial bid for Horizon. So I think it's probably going to be a pretty happy weekend in Thousand Oaks.
So what's your outlook for the combined business going forward, Mark?
Yeah, I mean, I think it will serve a clear need for Amgen, which is to bring in some additional revenue, some help on the top line where they've sort of been a little bit stagnant over the past few years. Horizon's products brought in $3.5 billion or so last year. Bloomberg consensus calls for $7.5 billion by 2030. So this is really going to reinvigorate the growth story for Amgen as their pipeline, which is extensive, you know, hopefully will also produce some wins.
Jen, does this mean anything in terms of what the FTC might now do on Microsoft, Activision and so on? It's still fighting that tooth and nail, even though the court has vacated any reason really for it to fight.
Yeah, no, it's still fighting that one. I think it didn't really like the lower court's opinion, at least on the law. And even if they can't overturn the ultimate result, I think they might like to continue that appeal just to sort of fix what they saw as an error of law. But I do think for some of the deals that are pending and for deals going forward, this could be an indication that the FTC's lightened up a little bit on their stance about settling matters rather than challenging them. So if you go forward with a reasonable proposal, you know, maybe now you have a chance to settle.
All right, Jen, thank you so much to both of you. That's Jennifer Rhee and Mark Engelsgaard. Still ahead, we're counting you down to the closing bell right here on Bloomberg Television.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
This is the countdown to the close. I'm Vonnie Quinn with Kaylee Lyons. So, just want to point out that we have some indexes, but they're not really too much on the move. The Dow is about the best performer right now, and when have we last seen that? The Dow up about 0.3%. We have the S&P 500 only up 0.1%. That's a 4-point move today in spite of everything going on beneath the surface. And then the Nasdaq is down about 0.1%, belying everything else that we saw today, including a round trip in yields from 4.74 all the way back up to what they are now, 4.87 on the 2-year, 4.17 on the 10-year, and that, of course, was all down to jobs data and ISM manufacturing. Kaylee, what are you watching?
Yeah, well, I'm watching how there's just a surprising lack of volatility in the equity market with a VIX at a 13 handle, Bonnie. Yet you are seeing, as you point out, that whipsawing in bonds. And I just wonder how much we should chalk up the activity we're seeing to the fact that it is the Friday before Labor Day. Liquidity is pretty thin out there. Or is it this idea the economic data right now is just really confusing? You could pick and choose the parts of the jobs report you might want to look at. The idea that there is more entrance into the labor market. There's strikes you have to contend with as well, but you also got a stronger than expected print on the ISM figure. So what does that all add up to, and what does it mean for the Federal Reserve? I think that's what this market is trying to figure out.
Well, I think you put your finger on it there, Kaylee. Even Mohamed El-Erian telling Bloomberg that investors have become too fixated on each economic statistic without seeing the bigger picture. So let's get somebody else's thoughts on all of this. Let's welcome Jason Pride, Private Wealth CIO at Glenmead. So, Jason, is Mohamed El-Erian right? Are we too focused on, how many jobs were created, how much wages have cooled, and whether the Fed will go again this month or next month?
Look, quite often we get very focused on individual data points and the individual outcomes. I think the big picture is what's really important here. On the surface here, what we have is a tight labor market that's starting to loosen up. It's doing exactly what the Fed wants to do, but there's this question mark as to whether, with all the moves they've made, they've actually taken so far, where it's going to start snowballing in a bad direction. I think that's something we have to watch out for. You mentioned the ISM report a second ago. In the 47 range, that's actually in between what we consider to be clearly recessionary, which is 45 and below, and what's robust economic growth, which is 50 and above. So I think that kind of paints a nice picture around this market. This is a market and economy that's essentially borderline recessionary because of the magnitude of rate hikes that the Federal Reserve has had to put into place. Now, for investors, I think the interesting thing to do looking at that is you see a stock market that soared on this belief that we're in a soft landing scenario, not really taking into account the recessionary circumstances. And you have a bond market that, because of what the Federal Reserve has done, has pushed rates up high, making the bond market actually relatively attractive. It's pretty easy from an investment standpoint to actually look at that and say, well, I'll just build in a little bit extra defense in my portfolio, collect those higher yields, and deal with the stock market at a later point in time. Keep that weighting a little bit lower. That's probably the right path through this environment.
Yeah, I mean, it sounds wise, I guess, unless you miss out on a whole bunch of gains, which, who knows, right? We will see this time next year. But Nouriel Roubini certainly thinks that we might see a 10% correction. Are you going so far as to forecast a potential correction? Or are you just saying, look, we don't know enough right now, so let's not go there?
Look, we think we're more likely than not. We think we're actually going to see some sort of mild recession at some point in time here. That could cause equity market corrections. What it means to us is that the equity market's risk reward is really not that good at these valuation levels given those circumstances. Whereas the bond market at 4, 5, 6% yields, that actually is a pretty good risk reward in those circumstances. So we're going to tilt portfolios that way. That doesn't mean we're absent equities. That just means we have a lower weighting in that asset class at this point in time and a higher weighting in the fixed income asset class, given the relative attractiveness on a risk-adjusted basis.
Yeah, Ian Lingen of BMO Capital Markets told me earlier this week, Jason, that the 10-year was a screaming buy. I don't know if you agree that it's scheming, but that would kind of fit in with your thesis here, I think. What would change that for you? What do you need to see to decide that equities are more appropriately priced and it is potentially time to think about a greater allocation toward risk?
Absolutely, and we always do contingency planning on this. So we have 3 paths to get ourselves more constructive on equities. Number one is that this soft landing scenario actually comes to fruition. We still think the evidence is pointing in the wrong direction on that. Number two is that the recession actually starts, because the instant everybody recognizes that this is actually a recession that we're in, market will probably be pricing lower and we'll be looking forward to the green shoots ahead at that point in time. Now, the third thing that's kind of attached to that is if that recessionary environment comes about, equity markets will be lower valuations will also be something that brings us back to the table. So right now we're just sitting patient with our slight adjustment in those weightings and waiting for one of those 3 scenarios to develop more clearly.
And obviously when we're thinking about especially those richer valued stocks, that's where the rates conversation comes into the picture, the pressure we are seeing from higher borrowing costs. If you think that treasuries offer attractive value here, that perhaps the recessionary factors come into force and those borrowing costs go down, does that mean that it is some of those higher multiple stocks that would actually fare better in the environment that you're looking ahead to, even if that is maybe counterintuitive?
So that is how it's played out in some circumstances, all right? And you have to go back and look at different recessionary periods, or even just different, more modest or difficult economic periods, not even just recessions. Some of those environments, you have situations where portions of the market started really high multiples. And because of that, even though they have typically defensive characteristics in those rising rate environments or in those more difficult environments, they're actually hit the hardest in that period, even though their businesses are more stable. 2000, 2001 is one of those periods where that occurred. Other markets where those sort of areas, those more stable markets, stable portions of the market start at a more fair valuations, they don't experience quite as much downside because the fundamentals are there for them to hold in the more difficult economic period. This is one of those where we're starting with a number of those businesses at higher valuation levels. So I would think that they're more susceptible to downside.
Jason, you're CIO of the Private Wealth Unit. I have to ask you what your clients are thinking when it comes to the IPO market and, say, this ARM roadshow next week, and whether things are loosening up a little bit and whether they want a piece of it.
Look, we like to see that portion of the market actually performing well. That tends to be a better sign for the economy on the whole on a go-forward basis. Are we participating in that on an active basis? I would say here and there depends on the circumstance surrounding the exact IPO. We are not chasing after a lot of these high flyers right now, so we're probably sitting on the more defensive side of the equation and being a little bit more on the hesitant side of recommending those sort of investments.
What about other assets, other alternatives perhaps, Jason? Where does that fit into a portfolio allocation?
Sure. So there's a couple of things that we do as alternatives. Number one is it's not all just about large caps. Within equities, we consider small cap and international stocks. Both of those we consider to be at more fair valuations at this point in time. We also think about real estate, private and public markets. Actually, we find a little bit of opportunity in the real estate space in terms of REITs, particularly if you stray from the office portion of that part of the market. We also find opportunity, just generally speaking, in private and alternative investments. Those alternative investments we're de-emphasizing a little bit just because fixed income is more attractive today. But private investments in general are a typical allocation for us for clients that are willing to take on some illiquidity risk in portfolios.
Jason, this may not be a conversation piece between you and your clients, but certainly between you and your peers, you must be considering what's going to happen with the commercial real estate market. Are we in for a reckoning in the fourth quarter?
I think we need to differentiate here between commercial real estate broadly and office real estate. Office real estate has its issues in terms of supply, in terms of the demand characteristics, given the move towards remote or hybrid workforce. The rising rates are just making that more apparent at this point in time. If you actually pull that out of the commercial real estate market and look at everything else, if you think about warehouses, if you think about retail space, oddly enough, retail is actually doing reasonably well. If you think about data centers, even cell towers are within real estate space at this point in time. Majority of those are actually doing reasonably well. And that's the reason that we think commercial real estate on the whole is okay as an investment. Commercial real estate construction is bad because of the lending scenario, and that office part of the market has to find its way to settle out.
All right, Jason, thank you so much for joining us on this Friday afternoon of Labor Day weekend. That is Jason Pride of Glenmead, and we're very happy
Thanks for
to chat
having
with
me.
you. Well, Kaylee, it has been the first trading day in September, not quite the fourth quarter, but we're also heading towards the end of earnings season. And I don't want to say it was underwhelming. It's been whelming.
Yeah, I guess it has, maybe beneath the surface more so as we look at the S&P 500 here, looking like it's going to close the day higher by just more than 0.1%, 45.16 roughly where we are, Vonnie.
Yes, a lot to digest in this market today, and you wouldn't know just by looking at the overall numbers. As you can see, we've settled with the Dow up 1/3%. When did you last see the Dow outperform or underperform either of the other two indices? It's been a while. Well, the S&P 500 up 0.2%. It managed to claw back from those declines and end up an underwhelming 0.2% higher. And then we have the Nasdaq flat on the day. After what a year to have the Nasdaq flat on the first day of September, it's a little bit of a disappointment. But as you said, Kaylee, the VIX at 13, what to expect? And then, of course, some of the big moves today were in the energy space. We had Brent and WTI up more than 2.5%. Kaylee.
Yeah, and that was feeding through to the performance you were seeing on a sector level. Far and away was energy the best performing in the S&P 500 today, up more than 2%. So that is where some of that outstanding performance really came in. Some of the other cyclicals like materials and banks were also in the leader section, the green section of the sectors, Vani. But it's interesting to see what was lagging. Autos, the S&P Autos and Comp Index, which only has a few members, Tesla being the most heavily weighted. That was the big underperformer, down by about 4%, Bonnie.
Yeah, it's interesting that Tesla seems to constantly make news. Up about 100% though year to date so far, which is fascinating. Let's have a look at some of these gainers, because as I said, energy was one of the big areas where we saw gains today. Well, Freeport-McMoRan of 4%. That was definitely an outlier. Valero, Marathon, some of the other oil majors also following it higher. Hewlett-Packard up another 6%. Hewlett really changed the game, changed the conversation this week, as we heard earlier. We saw Dell up 21% today as well. There seems to be a lot of optimism around the personal computing space. And then Illumina as well, we talked about that. A new CEO potentially in the works, or at least the threat of activism may be going away for now. That has that stock up 2%, which is a big move on a day like today, although maybe not necessarily for a biotech. And then Intel, I mentioned, up about 4.2% there at 36.61. Intel's Pat Gelsinger has a feeling that things are going to be better, and that was enough to let investors send that stock higher by more than 4%, Kaylee.
Yeah, I guess the vibes are good out there, Bonnie. To your point on Dell, record gain of 21% and closing at a record high. Not all stocks were so lucky today, though. Plenty of decliners out there, and a lot of them actually in the media space. You had Disney failing to reach an agreement with Charter in regard to distribution, and there's a concern now that for these media players, they are losing their leverage, their pricing power, their ability to negotiate on these matters. So that didn't just drag on Disney and Charter. Charter closing down by about 3.6%, but other names as well. Warner Brothers Discovery down 12% on this Friday, the worst day going back to November of last year. You had Paramount Global down about 9.5% as well. And then I just wanted to mention Walgreens Boots Alliance down 7.4%. That is the CEO of the company stepping down, showing up in the performance of the stock. And that actually leaves, Bonnie, the S&P 500 without a single company with a black woman at the helm as chief executive. Really interesting to see that story playing out and having a financial impact today.
Yeah, I mean, there's just no words for that, really, is there, Kaylee? Let's look at yields in the meantime. We have the two-year yield at 487.23. That's the yield that's really drawing the most eyeballs at the moment. It's the one perhaps most sensitive to the Fed's immediate moves. And given that the Fed is going to be on pause, most likely in September, following today's data, well, we are where we were yesterday, which would make sense, except for the fact that we dropped all the way down to 475 and change after the jobs report came out. So clearly the bond market was, not particularly expecting these kinds of benign numbers. Then again, we got the ISM manufacturing data, maybe a little question mark over employment and some of the other factors in there like producer prices, and that was enough to turn the bond market around once again. A very sensitive area of the curve too, of course, and it is going to lead the rest of the curve no matter what happens over the course of the next 6 months and well into next year. Don't forget, we're talking now about perhaps at least a half a year, if not more, where the Fed won't be cutting at least. And it could be a lot more than that. So that's where we're ending the 1st of September with those yields. So joining us now is Bloomberg's Jess Menton. And Jess, interesting day. You were watching the market all day long, and there was a lot going on today. But like I said, if you just arrived at your desk at 4:01, you would have been like, oh, nothing happening today.
Right, especially going into a longer holiday weekend with Labor Day coming up and the market's closed on Monday. And especially to your point, because we got the jobs data and then seeing the movements, especially what you're noting in the 10-year, particularly where it started, especially with the yields moving higher. And then a lot of my sources really feel like the few that were still working today, right, and didn't go on holiday for this weekend.
They answered you anyway, even from the beach.
Exactly, the traders that did stick around. Really a lot of just the lower liquidity there. So then you're more easily able to see those moves in the bond market, particularly ahead of this holiday weekend. So really exacerbating some of the moves there. But to your point, I mean, talking about the jobs data, but then countering that to some of the manufacturing data that did show a little bit more stabilization there, because there were those questions about when would the bottoming and the pain stop with manufacturing. And then obviously heading into September, we all know is typically the worst month when you are thinking about stock market performance just throughout history, SEAG go. But I would say actually Bank of America had a counterpoint to that. And whenever you do see years, right, more optimism there. Whenever you do see years with the S&P 500 up at least 15%, right now it's up close to 18% for the year. Typically September actually does perform better. Now, that doesn't mean necessarily that'll happen this time around, but earnings season is pretty much almost done. We do have a couple names next week, like Kroger's one of them. I think we do remember the last time around when they reported and they had 8 mentions of AI, which was very different for a company like that. But we do have other names like DocuSign and that. But nonetheless, most of that is over. So really it's a lot. And even the macro calendar, not a ton on it next week. We do have consumer credit and things like this. But next week actually is the last week of Fed speakers before the blackout week, before the September 20th decision. So a lot of focus is what is their commentary going to be like on the back of some of the data that we got this week.
But it does seem, at least going into this new month, that the narratives aren't changing anytime soon. So it is the AI narrative, it is the Fed narrative, and we kind of know what the Fed's going to do unless something, radical happens. Yeah. So why should we anticipate that September we'd suddenly see a stalling out?
Exactly, and a lot of it is more just because of the way that the quarter ends, especially usually it's not the first half of September that's weak, it's the back half because of more window dressing and what companies are doing toward the end of that quarter, especially if you are trying to sell some of the losers that you had. So typically if we are going to see some underperformance in September, it wouldn't be surprising to see it more in the back half of that.
Okay, Jess, finally, when we're talking about, and I know you said liquidity issues are exacerbating a lot of what we've seen in the bond market, but is this now a market where you're looking at that every individual data point, we're going to go one direction or another, and we are just as data dependent as the Federal Reserve is?
I don't think so. And the reason is because when I speak with my sources, we really saw that last year, right? When you thought about especially the CPI reports. We will have CPI again, of course, on September 13th, about a week ahead of that decision. But a lot of the macro just hasn't had the same types of effects that, say, the moves we would have seen a year ago, just because, not surprisingly, right, inflation is continuing to ebb. So it'll be interesting to see also more so what's happening more in the yield space as far as what's the breaking point there. If we continue to see yields move higher, a lot of discussion. If, say, we see yields around 4.5% on the 10-year, that's something that could really move, especially longer duration tech and growth stocks. But then also the dollar, if you look at the DXY trading around 103 right now, that's been a really key technical level for that. So if you do see more dollar strength, which the dollar has been higher the last 6 years in September, that along with what's happening with yields probably will direct the equity market more so than some of the data points.
Well, Jess Menton, thank you for being here with us today, and I hope you have a lovely weekend and we get to do all of this all again next week and into September. That's Jess Menton there. Coming up, Danish drug maker Novo Nordisk is now the most valuable company in Europe. We'll hear from the CEO and president next. This is Bloomberg.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
Well, traders are digesting a week of economic data that does suggest the U.S. economy is cooling, potentially still heading for a soft landing. We saw a move higher in yields today after initial move lower on the jobs report because ISM numbers dampened that initial reaction. BlackRock's Rick Reeder, though, sees this week as a bullish sign for bonds.
If you believe the Fed is done and you're not paying a lot for the forwards because the markets have priced out a lot of those cuts, that you can actually extend a bit further out the curve today, lock in some of these yields, not just in treasuries, but in parts of the credit market, mortgage market, securitization market. So I think you can put your shoulder behind a bit more of interest rate exposure than has been the case certainly over the last few months.
Let's see where Bloomberg Intelligence U.S. rate strategist Ira Jersey stands after today's data. He's joining us now. So Ira, there was some whipsawing today, to be sure. Maybe we chalk that up to the fact that it is the Friday before Labor Day weekend. But should people consider buying treasuries here anytime we do see selling pressure come in like we did in the later part of today?
Yeah, so I think that we're at a kind of an inflection point, and we were at an inflection point actually late last week, early this week, when you saw 10-year yields back toward that 3.35% kind of area. We do have to take a lot of these moves with a grain of salt, though. I was looking at the depth of the market earlier today, and usually you can do about $250 million 10-year notes and sell them for 2 ticks for 230 seconds. And today, for most of the day, you couldn't do that for more than 100 million. So you're talking about a depth of the market that's very low. And I think that a lot of people, maybe fast money, hedge fund folks who bought earlier in the week were just, unwinding some positions before going away for the long weekend.
Okay, so that's what was happening today, September 1st, but it becomes a question of what this market is going to see on September 13th. Then again, September 20th, when we get CPI and the Federal Reserve. Ira, what do you expect we're going to see? What will the data indicate, and how is that going to translate into this market?
Yeah, so I think I would be surprised if the data was significantly different than the trends that we've seen recently. Inflation is moderating a little bit, but not particularly fast. And I think that the Federal Reserve, in their summary of economic projections when they come out, is going to probably reflect that. And I would not be shocked if the median dot came down. Remember, we're still with where the dot plot currently is, suggesting that there's going to be another hike, but not every member of the Federal Reserve believes that. So you mentioned in the last segment about the Fed speak coming up next week before the quiet period, and when Jess mentioned that, it made me remember that, look, this is kind of their last chance to prep the market for that dot plot and the summary of economic projections. So when you listen to Atlanta Fed President Bostic and some other people saying, hey, we're already restrictive, that suggests to me that maybe the Fed is actually done. And if that's the case, then Rick Reeder's comments that he made before is probably right, because duration tends to do really well in situations like this.
So, Ira, what happens when we get a whole bunch of supply for the rest of the month?
I'm sorry, say that again, Vi.
When we get a whole bunch of Treasury supply, because we're going to get a lot that come online in September, does that change the picture at all for you?
Yeah, a little bit, but remember, that's known, right? So we really got the move from supply back in early August when the Treasury Department announced the refunding statement and how much they were going to issue in terms of notes and bonds this month. And that did surprise, right? Because they did increase the amount of 10-year notes and 30-year bonds in particular more than the market was expecting, more than we were expecting as well. So I think the repricing for the supply is done. It was pretty impressive how strong some of the auctions were this past month. There weren't a lot of tails. There was pretty decent demand at most of the auctions, and I think that was in large part because we had sold off, right? So the market basically prepared itself for some of that additional supply. I think the supply that we get in the middle of the month might be a little bit, less, more focused, or might be a little bit less demand for that because it is coming right before a Fed meeting where you're going to wind up probably getting an idea about where monetary policy is going to be for the next 15 months or so.
So, Ira, if that all is priced in, what's not priced in right now? And not of all the scenarios out there, but what are some scenarios that might not be priced in?
Yeah, well, so I like to look at things that are going on in the options market, and these are options on SOFR futures, the replacement of Eurodollar futures. And so one of the things that we always talk about, the market's pricing for, this % odds of a hike or cut. But when you look at the options market, what's really interesting is that the market for the end of next year is pricing for interest rates maybe only to be one cut or to be 100 or 125 basis points of cuts, right? So even though it seems like the market's pricing maybe for 50 or 60 basis points of cuts, that's actually just the average of kind of this bimodal distribution that the market's pricing in. So, which is pretty interesting, which means that maybe, looking at volatility, vol markets are very high. You look at implied volatility being as high as it is right now. So if maybe if you think that, look, that median is going to be right, then implied volatility might be pretty high, and that might be a little bit mispriced at the moment.
Amazing. Ira, just constantly full of the observations. Can't wait to speak to you again next week and beyond. That is Ira Jersey of Bloomberg Intelligence. Coming up, Danish drug maker Novo Nordisk is now the most valuable company in Europe. We'll hear from the CEO and president about their blockbuster obesity drugs and how they're ramping up production. This is Bloomberg.
The more my company grows, the harder it is to stay focused on our core product. I need to master DE&I, ESG, M&A, even how to adapt to hybrid working. The more hats I wear, the more I need Aon. They bring their whole team to the table and give me access to great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
High demand for diabetes and weight loss drugs have thrust brands like Ozempic and Wegovy into the spotlight, and the company behind them has now become Europe's most valuable company, surpassing the likes of luxury powerhouse LVMH. The company in question is Novo Nordisk, and Bloomberg's Katie Greifeld sat down with its CEO and president earlier today.
Lars, great to have you with us. Let's start with the news of the week. The Biden administration coming out on Tuesday with the names of the first 10 prescription drugs that will be subject to price negotiations with Medicare. And there's a lot of speculation among the analyst community that Ozempic could be next on the list that's due to be announced in early 2025. How are you preparing for that possibility?
First, we'll deal with the insulin product that's now on the list. It's important to understand that we operate in a highly complex market structure and already give significant rebates. What made our product go on the list was the gross price before rebate, and I look forward to understand what negotiation means. I have a concern that it could turn into price fixing, which I think is bad for patients and access to innovation. So it's still a bit early for us to judge what this exactly means.
Do you plan to engage with the administration, engage potentially with Medicare over that issue?
Yeah, as I understand it, there's going to be a dialogue over the coming months in how to interpret what this negotiation entails, and there's a number of data we need to submit before that negotiation starts. It's important for me to underline that our prices are actually declining significantly. We see that the insulin price point is deteriorating by some 20% year over year. Unfortunately, those rebates that we pay into the system is not shared with patients, and that leads to this affordability issue for patients. And so we support anything that's help patients afford their medicine, but I think it's also important that we use this opportunity to come clean on what is actually the price and the price development for manufacturers, which is actually a quite negative story.
And Lars, I know there's a lot of questions here. There's still a lot to be figured out. And of course, we don't actually have that list in hand yet. But hypothetically, if we did see Ozempic targeted for price cuts and it becomes much cheaper than Wegovy, for example, what does that mean for your products in the U.S. market?
Well, we believe that we have a class of medicines here that's actually turning into deliver more and more value. We have just seen recently that there's significant cardiovascular benefit of being on our medicines, not only for type 2 diabetes, but also in obesity. So we'll obviously try to argue for the value of our medicines, which is really why the uptake is so significant as it is, because physicians and patients see that these are really valuable products, and we are adding new indications to them over time. I think that should go into the overall negotiation of what is a fair price for these highly efficacious medicines.
And let's focus specifically on Wegovy, because the rollout in Europe has been slower than initially promised and initially hoped for. When do you see that picking up? What still needs to happen?
Well, we see a very, very positive business setting where the demand is way larger than what we have been able to supply so far. So the fact that we are rolling out slower in Europe than originally anticipated is really on the backdrop of a very, very positive demand situation. So in the markets where we have already launched, we see a way larger pull from patients and physicians that we had planned for. So we're basically selling everything we can produce. And when it comes to manufacturing, we are ramping up significantly as we speak. If you take our best-selling medicine, Ozempic for type 2 diabetes, that grew the first 6 months by 59%. And that's actually lower pricing. So underlying volume growth is much higher. So we are adding a lot of capacity, and we are ramping up manufacturing to help all the patients who want to be on our medicines.
Well, let's stick on Wegovy supply and bring this conversation to the United States, because there's been reports that you've hired Thermo Fisher to help
fill Wegovy pens in the U.S. So a two-parter here. Is that true? And how soon would you expect added supply to actually hit the market?
So we have a policy of not really talking to the names of those who work with us. I can say that we started the year with having one contract manufacturer. We have one more line operating already, and we are working on getting an additional line in. So you can see that we are constantly ramping up the number of lines we supply the U.S. market with. And that's what's leading to this very significant growth we see right now. Still, the demand is bigger than what we can supply, and that has led to us reducing the number of starter doses because we want patients to have a good experience and being able to titrate up on the maintenance doses. So you can rest assured that there will continuously be more and more products coming into the market so we can serve more and more patients.
And demand being bigger than supply, in many ways, that's a good problem to have. And we only have about a minute or so left with you. But when it comes to Novo's growth from here, let's talk about your acquisition strategy. You recently acquired Embark Biotech just last month. Are you planning further acquisitions here to help continue to grow?
We have the ambition of building the strongest pipeline in the industry when it comes to both diabetes and obesity. We have a really strong in-house research and development capability, but we also see an opportunity for adding, complementing with assets from outside. And we have over the summer acquired 2 such assets, and we will continue to look at what's outside of our own laboratories, but the most significant part will still be organic research and development from our own research folks who have great ideas for how we can help patients and develop more and more efficacious weight loss agents, but also, say, high-quality weight loss, because it's not only about losing weight fast, it's also about the quality of the weight loss and the additional comorbidities, follow-on diseases that's benefited from treating obesity.
And that was Bloomberg's Katie Greifeld speaking with the CEO and president of Novo Nordisk. Coming up, millions of Americans are making their way across the country and even out of the country for the Labor Day weekend. We'll chat with Clint Henderson from The Points Guy about the trends he's seeing. This is Bloomberg.
The more my company grows, the harder it is to stay focused on our core product. I need to master DE&I, ESG, M&A, even how to adapt to hybrid working. The more hats I wear, the more I need Aon. They bring their whole team to the table and give me access to great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
I'm Bonnie Quinn, and let's take a look at how markets performed on the day, the very first day of September. As you can see, yields, for the most part, finished the day where they started them, but 4.8743% on the 2-year was an interesting round trip, right down to 4.74 at one point after the jobs data came out. 10-year yield still at 4.17, and the 30-year yield 4.29, less movement on that part of the curve. The Dow itself was up about 0.33%, but the Nasdaq was pretty much flat on the session. Plenty of moves within the Nasdaq, though, if we want to get into that. We had some major movers, including some of the chip stocks. The SOX index itself, though, was sort of balanced out. We had a bifurcation of the chip story, right? And so the SOX index ended up about up 0.33%. But within that, you had some major outperformers and some major underperformers. I do want to point out the Russell 2000. It was up 1.1%. For how long now have we heard that there's going to be a rotation to the smaller cap companies? Maybe it's beginning to happen. Today, it certainly did. The US dollar index as well. We've seen strength from the US dollar, I think it's fair to say, for quite some time now. The US dollar index about 0.4% higher. That, though, is partially a euro story today. We had some pretty dismal data out of Europe, and the euro itself trading at 107.76, weaker by almost 2/3 of 1 percentage point, Kayleigh.
All right. Well, Vonnie, I know a lot of Americans are traveling to Europe, maybe taking advantage of the fact that that euro is a little bit weaker. Let's talk about the travel sector, because international is one story, domestic in the U.S. is another. And actually, Las Vegas is making a comeback. The Desert City saw 3.5 million visitors in July. That's up 1% from a year ago, and the biggest July since before the pandemic. And it comes as nearly half of consumers in August were planning a trip in the next 6 months. That's the highest share all year, according to Conference Board survey data we got this week. And about 1 in 5 of them are going abroad. So, Vonnie, I guess you can kind of pick your poison. You could go gamble in Vegas, or you could go take advantage of a little bit of a weaker euro. That's what I'm going to do. I'm catching a flight to Dublin a couple hours from now.
Kaylee, you're going to Dublin City?
I am. I'm super excited. I was supposed to go for Blink 182. That concert is canceled, but I'll still go and
That's incredible. I'm actually very envious that you're getting to my home country. I'm not from Dublin, but Dublin and its Temple Bar and its outskirts have always been very entertaining, as long as you don't stay out too late and bump into those bachelor and bachelorette parties that are trying to squeeze past you. But you got to get to the Guinness Storehouse. I'm sure that's on your list.
Oh, yes. We got that booked. Lots of activities. I'm sure a lot of Guinness will be drank this weekend, Vonnie.
No doubt, lots of rashers and sausages eaten as well. Well, we'll continue with travel as Americans hit the roads and take to the skies for Labor Day and for the weekend. Joining us now for a feel of what to expect is Clint Henderson, managing editor of The Points Guy. So, Clint, if we were to get the deals that we would have wanted, when should we have started booking for Labor Day weekend? Has that changed?
Yeah, so there are still, you can still do last minute deals, but you really would need to be using points and miles at this point, because cash prices for airline tickets are just too high last minute. You really want to be planning for international 3 to 6 months out, and for domestic 1 to 3 months out. But there are deals to be had out there. If you're sitting on a stash of points and miles, maybe you accumulated during the pandemic, you could book a last minute trip, even to Dublin. Right now, probably you could find a seat. So if you're ambitious enough, you can go last minute, but really you want to plan international trips a little bit more ahead.
Yeah, or Limerick, where I'm from, which is the southwest. Just, you know, no plug or anything like that. You can also go to Hell's Kitchen, where I'm also from. Clint, if you decide to use some points, is it better to start using them now? I have this sort of existential fear that some of these airlines are going to get rid of the, you know, couple of 100,000 points, or they're going to have them, or there's going to be some kind of halving in 2024 or something that I'm not ready for, and then I won't be able to use them at all.
Yeah, you know, we always worry about the next devaluation, and we have seen prices skyrocket for business class, especially. If you want to go to Europe, you know, you're now seeing dynamic pricing from airlines like American Airlines and Delta. We're regularly seeing 400,000 miles to fly round trip in business class to Europe. So devaluations are always around the corner. We always say earn and burn as quickly as possible in the points and miles games. You don't want to sit on those balances. I will say, with cash prices really high, it's a really good time to use points and miles, because you're going to maximize the dollar amount you're getting for those points and miles. So good time to burn those points you've been sitting on.
Yeah, but I guess the question becomes now, Clint, if we're going to see those prices start to come down. It's Labor Day weekend. It's the signal that summer's over. And I just wonder if travel demand is going to stay as resilient once we're out of this season.
You know, it's really interesting to watch the trends happen. I think usually we tell people, oh my gosh, shoulder season, this is the best time of year to travel. There's less crowds, it's cheaper. But we're still seeing super elevated demand for Europe, especially. So expect high prices even into the fall for Europe. I will say my favorite hack to tell people is to use vacation packages. So book airline and hotel together with AA vacations or Delta vacations, because you're going to save up to 40%, especially in the off season. You can get some great deals. I do think we're starting to see some moderation in prices. Las Vegas is a good example. We were routinely seeing $800 fares domestically to go to Las Vegas. We're starting to see domestic fares normalize a little bit. Trips to Hawaii, places that were really peak demand right after the worst of COVID passed, those have started to soften a little bit. I'm hoping we see similar trends to Europe in the next year or so.
Clint, can I also just say, I tried to do the responsible thing, and I planned this Dublin trip months in advance, as you suggest one should, only to have the Blink 182 concert I was trying to go to be canceled like 3 days beforehand. So, you know, planning doesn't always work out in your favor. But
no.
If I was not going to Europe, if I was picking somewhere domestically, Las Vegas or otherwise, what else is popular right now? Obviously, a lot of people wanting to go abroad, but when they're staying at home, where increasingly are they doing so?
So Orlando, really Florida has been going gangbusters since during COVID, actually. Anywhere that has national parks, so places like Bozeman, Montana, places like Washington State, Seattle's really popular right now. You know where you can find great deals right now because it's gotten a bit of a bum rap lately is San Francisco. Incredible deals in San Francisco right now, $200 for a 5-star hotel. So if you're looking to stretch your dollars further, look at big cities. Unfortunately, the places that are most popular, like New York and Miami, prices are really high. So that's what you're going to watch. The other thing I tell people is go local. If there's a state park you haven't been to, there's less crowds. It's going to be cheaper for you. So a good old road trip is a good way to sort of counterbalance some of these high prices.
Now, what about other areas? Because I feel like Europe always has that cachet, right? It's always fun to go to Europe. There are so many cities. They're, in pretty close proximity. If you wanted to do 2 countries in Europe, you could. What about Asia, Clint? Where is the tendency to go when it comes to Asia, particularly now post-pandemic when maybe restrictions are loosening a little bit for some of the countries that needed lots of proof of everything?
Yeah, you touched on it earlier. The euro has risen in strength against the dollar. It's not the bargain that it was a year ago, but Asia still is a bargain for Americans. A lot of countries within Asia, the US dollar goes very far. You can do 5-star resorts for $200 a night in places like Vietnam and Cambodia, Thailand, Indonesia. So if you're a little more adventurous, that's where the deals are. Unfortunately, the airlift to China has still not returned fully. So prices for China are insane. It's not only a tricky situation for Americans to go because you need a visa, but $5,000 for coach tickets to China a lot of times. So China's still not quite there yet. Hopefully, eventually it'll open up again. But right now, elsewhere in Asia is great value.
I think obviously, Clint, when we think about points, we often do think about airfares and buying tickets. But what about other mechanisms of travel? What's the cruise scene like, for example?
So it's really interesting. The cruise was the last thing to recover post-COVID. So what happened was we were seeing really good deals for cruises. That's gone. So the cruises have become very popular again. They are regularly selling out and prices have normalized for cruises. So you're not seeing the deals that we once had for cruising. That said, there's a lot of inventory out there and you can find some deals. Virgin Cruises is a great example. They run promotions all the time. There are deals to be had out there. They're just not quite as widespread as they were maybe a year ago. So that's a great trip. Gas prices have stabilized a bit, similar to what we saw last summer. So a road trip is not a bad idea. But of course, look for deal alerts. We publish a daily deal alert at the Points Guy. We've seen some last minute fares, even to Europe, for under $500 for coach tickets. So the deals are there to be had. Subscribe to our newsletter. We'll send those out regularly to consumers as well.
All right, Clint Henderson, managing editor of The Points Guy, thank you very much for joining us. Happy Labor Day weekend to you. And on that note, with all this talk of travel, I have a flight to catch, so that wraps it up for me. But Vonnie has more for you coming up. We're going to hear from former U.S. Treasury Secretary Larry Summers about what he thought of the August jobs report. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
It is time now for our Wall Street Week daily segment. David Weston joins us now. He had the chance to catch up with Larry Summers today, and of course, Larry, always a fascinating guest to have. What were his thoughts today?
And on this last Friday before Labor Day, fittingly, it was all about jobs. And so we asked Larry, who's been concerned about the job situation and whether it might keep inflation going, is he feeling a little bit better about the situation today?
The economy still looks strong with reasonably robust employment growth, slightly greater than expected. Hours per week ticked up, which is another favorable indicator. Yes, the unemployment rate went up, but it was driven by the fact that more people want to be working and have been pulled into the labor force. And that all happened with wage growth slightly less than was expected. So I think it's a mistake to make definite judgments based on one number, but this is certainly a favorable set of numbers which should please policymakers both on Constitution Avenue and on Pennsylvania Avenue. I still think the road to a soft landing is a very difficult one, but this was a step down that road.
So let me pick up an analogy you've used on this program before about trying to land the plane. Given these numbers, does at least it look like that we're on the right glide path? Not saying we'll succeed, but we're at least on the right path.
These numbers are consistent with very optimistic scenarios. I don't think they determine that they're in a very optimistic scenario, but there are all sorts of things that could have been alarm bells in today's numbers that didn't ring. And that alarm bell that didn't ring, like Sherlock Holmes' proverbial dog that didn't bark, is a meaningful sign that should be recognized. You know, David, as I look to the wage picture, though, I do see, and I think it's very hard for anybody to evaluate the significance of this, a degree of labor restiveness in our country, potential strike activity that we have not seen in a very long time. The Hollywood writers are getting attention, joined by the actors. There was a quite strong wage settlement that was probably not consistent with 2% inflation at UPS a few weeks ago. And of course, the big thing out there is the talks between the automobile companies and the auto workers. That's traditionally been a major template in the economy. The union is very ambitious in what it is asking for, and there's been a lot of workers left behind, and the companies have done well. So one can understand the union being very ambitious, but how that works through, both in terms of potential disruption to the economy if there's a strike, and in terms of inflation pressures, is going to be something people need to watch over the next month.
Larry, you've been in more than one administration in Washington. Take us inside that right now and how the Biden administration might manage, particularly that UAW situation. The president said he is the most pro-union president in history. How does he take that position and help the workers catch up? Because a lot of people think the workers do need to catch up some without going too far and both stoking inflation and perhaps even taking a bunch of workers out.
I think it's very difficult, and I think it's also important to remember that unlike the railroad strike, and unlike potential strike, and unlike some other issues, the federal government has only limited nexus with this situation. So I suspect they will be watching closely, trying to encourage both sides to come together, but avoiding getting too much responsibility for the outcome. These are very difficult situations for administrations.
Larry, I'm mindful of the fact that as we now enter September, we have by the end of the month the end of the fiscal year for the federal government. Give us your take right now on where we are on our fiscal policy, how much money we're spending, by the way, how much money we're borrowing.
Look, I think this is going to be a coming story. I have for a number of years, David, as you know, as I talked about secular stagnation and the like, I felt we needed more expansionary fiscal policy. That is all in the rearview mirror, given where we are now. The thing people are going to have to understand as the fiscal year figures for this year come in is that they are flattered by the fact that the Supreme Court repealed student debt relief. And so its whole cost has been added in as a revenue item this year, and its whole cost out many years was added in as a cost item last year. So that reduces the swing. If you take the swing out, I think you're going to see, even as we had a very strong economy, very significant, perhaps 3% of GDP fiscal expansion from 2022 to 2023. That helps to understand why the economy has been so strong in the face of high interest rates. It points to continued pressure on the economy and is one of the reasons why I've been saying that neutral interest rates are going to be very high.
And what can the federal government do as a practical matter to address that problem of the deficit? We've committed to an awful lot already. There are a lot of things that need to be spent money on. At the same time, we don't seem to be able to get our arms around this. In fact, if anything, they're talking about shutting the government down.
Look, shutting the government down is a cheap stunt that doesn't save any money and further serves to disillusion people with Washington. And I hope that it won't happen. And frankly, the divisions within the Republican Party with some very radical individuals who really are not wishing for the best for the country, but are wishing for conflict for its own sake. I think that's a significant part of that problem. I do think it would be helpful if we could get to more realistic views about the fact that we're going to need more revenues in this country, and probably ultimately not all the revenue that we can need is going to be able to come from the very wealthy. But I don't think that's an issue that's likely to be prominently surfaced in this political year. I hope afterwards we can recognize that given the magnitude of the national security threats we face, given the magnitude of the part of our population that's aged, given the fact that you don't get the same kind of efficiencies in healthcare and education that you do in producing flat screen TVs, so their relative price goes up, and given that we're going to have higher interest rates, we're likely to need more tax revenues than we have in the past, and we're going to have to figure out as a society how to adapt to that.
That, of course, was Larry Summers of Harvard, a special contributor in Wall Street Week. And Vonnie, we picked up on one of the things that Larry talked about, which is the labor strife we're seeing. We talked with the dean of the School of Industrial and Labor Relations at Cornell about what we're seeing with all those strikes and potential strikes, and also Steve Ratner, who was the car czar for President Obama, about the UAW problem in particular.
Fantastic, because it is certainly a moment for Labour, but how long does it last, and how many strides can Labour make during this one particular moment? And, for example, where is the future for the union movement? Do they gain members if they really, manage to succeed and negotiate?
Well, they certainly feel that they need to make a lot of progress in order to gain members. As you know, the private sector has been declining in labor participation. At the same time, Steve Ratner, who knows this area pretty well, is actually very concerned. He said, is there a gulf separating the two sides? He said, it's the Pacific Ocean. It's that big a gulf right now. He's very concerned about the demands being so high that the car companies can't meet it, basically.
Wow, and you're from Detroit, so you know a lot about...
yeah, I do, exactly.
Michigan, I should say, at least. So tell us who else. It's a conversation basically about Labour on Jobs Day, 1st of September, going into what could be the final season of the year, and then we may even have a shutdown at the end of September.
Exactly, which would be really a disaster. But in addition to all that, we get semiconductors in because of Gina Raimondo's visit over to Beijing. We've got Chris Miller, who wrote Chip Wars, who really explains everything about those high-end semiconductors. That's all coming up tonight on Wall Street Week at 6 p.m. Eastern Time.
Well, I cannot wait for one to watch, and that's coming up in just more than an hour. So, David, Thank you for that, and do all stay with us. Still ahead on The Close, what investors need to watch for the next week. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
Well, it's been quite the week, but let's take a look ahead to next week, because Monday, of course, enjoy it, everybody. It is Labor Day, and you do get a day of rest every now and then, so that's what you're going to be doing if you're in the United States for the most part. But then it all starts up again, because we have durable goods out of the United States on Tuesday. We want to be watching for that data point. And then Wednesday, the Bank of Canada will decide. Perhaps the Bank of Canada has done enough. We'll have to see. We did see GDP contract in today's data. That was another piece of data that came out today. And we get lots of Fed speak, and you know everybody is going to be parsing all the words of Susan Collins, Patrick Harker, Raphael Bostic and Laurie Logan after all of the data. Friday, consumer credit, another very important one to watch. Stay tuned. More Bloomberg Markets to come.
I'm head chef at the Mariah, an unbelievable cultural oasis. People from all over the world get to experience fine dining, arts, and events here. And it's my home, a reflection of Saudi's culture and beauty.
This is Bloomberg Markets Today. I'm Anna Edwards, live in London. Mark Cudmore, our Markets Live managing editor, joins us from Singapore to take us through the market action this hour. The cash trade is just an hour away. Here are your top headlines. Chinese markets rally, driven by property stocks as home sales jump in response to recent policy change. European futures are higher as the latest US jobs data boosts the case to end Fed tightening. Italy's Deputy Prime Minister tells Bloomberg the country may look to hasten the sale of Monte dei Paschi amid Rome's proposed move to offload some of its holdings. Plus, the race to dominate the global EV market heats up. Both BMW and Mercedes unveiling their latest concept cars aimed squarely at Chinese consumers. We are live from the IAA car show in Munich. Welcome to Markets Today, everybody. It's just gone 7 o'clock here in London this Monday morning. Mark is with us in Singapore. Mark, good morning to you. What are the markets saying to you this Monday?
Good morning, Anna. Well, it is a very positive day in Asia, mainly led by another round of policy measures out of Greater China that has boosted those stock markets, particularly helped by the fact that Hong Kong was closed in that positive Friday session as well. So it's playing catch-up and leading sentiment higher across the board. Otherwise, understandably, given the US holiday, it was pretty quiet, and we're still kind of discussing some of that data set we got on Friday out of the US, both ISM and the jobs data.
Yeah, absolutely. Lots of time to discuss that then, Mark. Let's have a look at where the futures picture leaves us here in Europe. As you point out, no trading in the United States. So we'll just give you the European futures picture. I know US futures are trading, but not showing any great moves. Nasdaq futures up 0.1%. This is the European picture then. Euro Stoxx 50 futures up by 0.4%. So we are expecting some positivity. Friday's session, we saw European stocks actually a little weaker, apart from London, where we saw some gains. And again, that's the commodity standout. And maybe that will be of relevance today. So that's where we were on Friday. This is the picture into the European session. And as Mark, you were pointing out, a lot of the optimism through the Asia session being driven by China. Some real evidence, perhaps, that some of the policies that we saw last week are having an impact on the housing market there. We're also seeing a lot of assessment, as you make the point, around the data that came out on Friday, and that is going to be part of our conversations this week. A lot to talk about commodities as well, as we continue to see, I was going to say firmer oil prices. Just a touch weaker this morning, but 88 handle on Brent. Mark, what do you see on the GMM?
Well, it is green across stock markets right across the region, led by China right at the top of the board today. I said Hong Kong is even higher, but this is G20, so that's not on this board here. Dollar slightly softer, but I wouldn't want to make too much drama about it. And it's in context that the dollar really had a great session on Friday on that data. Yields as well, nothing too dramatic. Treasuries are closed today. Treasury futures are implying slightly higher yields with a slightly steeper curve again, and I think that will be the theme of September, is that steepening curve. We're seeing a little bit higher yields in the Asia session, not too dramatic. And as you mentioned, Anna, commodities are softer today, but it's in context that they were higher last week, and particularly we're seeing energy prices have a real bid under them at the moment.
Yeah, absolutely. A lot to say about oil and what OPEC Plus does. And I note that the natural gas benchmark for Europe up again. Further news flow surrounding Australia, no doubt part of the story there. Let's turn to China, though, Mark. Chinese property stocks have surged as the nation rolls out further support measures, including lower down payments for home buyers and looser mortgage rules at major cities. Joining us now, Bloomberg's Alan Wan. And Alan, thanks so much for joining us. And the context here is China stocks seem to be rallying today, not on necessarily new measures over the weekend, but evidence perhaps that some of the measures we heard about last week are having a very timely, speedy effect on home sales, on the property sector. What do you make of the jump we're seeing in Chinese stocks today?
Well, yeah, I mean, definitely Marcus mentioned it. It is a big catch-up rally, but it's a fact that on Friday, the Chinese government announced that it's going to cut the minimum down payment requirements for first-time home buyers to 20%. That's nationwide. And for second-time home buyers to 30%. And we're seeing a lot of, and it's going to really impact the big cities like Beijing and Shanghai. And we saw that over a weekend. In Beijing, apparently 1,800 units were sold on one day alone on a Saturday, compared to like 3,100 for the whole month of August. And also, some good news for Country Garden as well. People familiar say that the distressed developer wired a coupon payment for its ringgit-denominated bond. Nevertheless, this could be just a reprieve, because over the next couple of days, it's going to have to pay back $23 million in dollar coupon notes.
Alan, good afternoon. Some marginal positives in the beleaguered property sector, but we know that's an ongoing structural issue. I'm struggling to keep up with all the policy measures. It seems like we get a new one every few minutes in the morning sessions at the moment. What are some of the other latest government measures we've seen today in terms of boosting the economy?
Yeah, I think that today, President Xi Jinping made some, he said some things that calmed some investors' nerves. Basically, at the International Trade Fair, he said China is going to continue to open up while pursuing its own development path. But he also mentioned that China is going to provide more market access to the services sector. And also, interestingly, the NDRC, China's National Economic Planner, said that it's going to set up a new bureau in order to provide support to the private economy. So all these are, all these comments are going to be soothing to a lot of investors worried about, what's happened over the last several months with the crackdowns.
Alan, thanks so much. Thanks for joining us, giving us the latest on the China story. Thanks to Bloomberg's Alan Wan with details on China, both the policy initiatives already announced, weekend developments and market response to them. Mark, let's talk about these markets in 3 minutes then. Let me start with the data out on Friday. Your thoughts post-Friday, post the jobs report and the ISM, and how comfortable are you in the light of that with your pivot around treasuries last week? I see that BlackRock talking about 2-year treasuries as a screaming buy, and I thought of you.
Yes, absolutely. I was delighted with that BlackRock headline, getting on board the trade. Look, I think the data on Friday overall was a slightly stronger data set, but I don't think it was game-changing either way. And absolutely, I'm still very much behind my major turning point call last week that it's finally time to get bullish 2-year paper in the US after being very bearish at the last couple of years. And I think the reason on the data on Friday was that, yeah, sure, ISM data was strong, but remember, it's still in contraction territory, so it's just slightly better than expected. I think the fact that prices paid is where we saw the big jump does show that we still have an inflation problem, even as growth is slowing. And I think on the jobs data, yes, it's true the participation rate picked up, but a lot of that's from younger people, and this is about summer employment, and they'll probably come back out later on. The fact is the unemployment rate did jump up, and the reason we're having a higher participation rate and a jump up in the unemployment rate is because people want jobs more than they did only a few months ago. And that is because excess savings are getting eroded down by the consumer. So the data set backs up the idea that the consumer is about to go off a cliff. And that is the main reason behind my view that I still think the US goes into recession in the fourth quarter. And I think it's now time for two-year yields to have peaked out and to come lower over the coming months.
OK, if the consumer is working their way or has worked their way through those excess savings then, Mark, then any pickup in commodity prices, in particular at gas pumps in the United States, will be felt negatively. As we've said, oil prices are pretty flat this morning, but 88 the handle on Brent, a reminder, you know, we're heading towards 90, it seems, a reminder of how far we've come on oil prices in particular, but it is broader across commodities.
Yeah, absolutely. I think the energy price is the big driver here. And obviously, remember, oil prices decide, really, or energy prices decide the cost of production, extraction and transport of all commodities out there. So that's why they're the most important ones. There's this kind of speculation at the moment that if Saudi Arabia is going to try selling another $50 billion in shares of Saudi Aramco stock, then there's speculation, I must stress it's speculation, that they're going to want to like boost the oil price until they sell their stock. And therefore, that's bullish for oil prices into year-end. So that's one of the big drivers here in the background. But we have this general theme that commodity prices have not reflected the negativity around China otherwise for the last couple of months.
OK, and let me ask you about stocks. Given your gloom that we get ready for around the US consumer later on this year, given that and the fact that we have seen Treasury yields rise, do you think stocks withstand that pressure? I know the MLive survey has been asking this question.
I think it's too early to turn bearish stocks just yet. I think stocks still have a bit more to gain. I think they're going to trade the lower yield story first before they trade the negative economic story, because I think people are going to be slow to realise how bad the recession actually gets. Remember, I think this will be a hard landing, but people won't realise that till the first quarter.
OK, remember you can get up-to-date analysis and insight from Mark and the rest of the Markets Live team. MLIV Go is the function to use on the Bloomberg terminal to get more details on any of those stories that we've just been throwing around and talking about this morning. Here are some of the things that we're watching for then in markets for this week. A reminder that today is a US holiday, so US cash markets are closed. It's Labor Day over in the United States. Then tomorrow, the RBA delivers its latest rate decision. We'll also have services PMI data from across Europe. On Wednesday, there's an update on German factory orders. Plus, the latest Beige Book is due out. On Thursday, New York Fed President John Williams will be speaking at the Bloomberg Market Forum. There's also China trade data out overnight that evening. And rounding out the week on Friday, we're due to get the latest UN food price index results. That's always been one that I know has got your attention, Mark, when it comes to those food prices. Interesting to see the China data. There'll be quite a bit of China data out this week. Eurozone inflation expectations also could be an area of focus. We've seen inflation, the rate of inflation has stopped coming down, it would seem, in the Eurozone, and that may be giving policymakers some making their life difficult. And we'll see what's reflected in expectations. Also, Bank of Canada, a rate decision there, which is interesting and complex, given the weakness in the data, strength of commodities.
Yeah, I am so excited by so much of the data this week. So in Europe, it's the Eurozone services PMI and those factory orders you highlighted. Remember, I think that the concern around growth in the very immediate term should be around Germany and around Europe, not so much around China, where the story is priced. It's valid but priced. In Germany, we're not paying enough attention to how bad growth is on the continent at the moment. So I think that's very important there. I think both RBA and BOC play into the idea that G10 central banks are either at the end of the cycle or very near the end of the cycle. And I think that those central banks are going to emphasise this story. And as you mentioned, those UN food prices, to me, one of the problems, the first time in about 40 years, we're going to go into a recession with inflation still being sticky. We've not experienced that for most people in their active trading lifetime, which is, I'm going to guess, for many people, not much more than 30, 40 years. They have not experienced a recession where we still have sticky inflation. And that's why it's going to be an extremely difficult one.
Yeah, absolutely. And how does that, the presence of inflation in a recession, how does that change the strategy? I know that Simon White on the Markets Live team has been writing about that. Coming up on the programme, we'll talk about cars. We're live at the Munich Auto Show with a host of interviews, including the CEOs of Renault and VW, plus more on China. Of course, Asia shares are driven higher after Beijing ramps up stimulus. We see evidence of it, perhaps at the margins only, but interesting nonetheless, of having an impact. But up next, US jobs data points to a potential potential reprieve in Fed hikes. Do you agree? We'll discuss how the markets are positioned following the print. If you have any questions of your own for our guests, please do get in touch. IB plus TV Go is the function to use on the Bloomberg terminal. And if you want to keep across the markets today, blog from the blog team, go to the Bloomberg UK website. You can click through to the blog there, or you can type TLIV Go on the Bloomberg terminal. This is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
Traveling through memories of my life, learning something new each and every time. On my way, on my way, on my way.
Although there has been some progress, inflation remains too high. And the FOMC is committed to moving inflation down to 2%. The monetary policy questions are whether the current level of the Fed funds rate is sufficiently restrictive and how long policy will need to remain restrictive to keep inflation moving down in a sustainable and timely way to our goal of 2%.
That was the Cleveland Fed President, of course, Loretta Mester, on fighting inflation. Joining us now, Jane Foley, Head of FX Strategy at Rabobank. Very nice to speak to you, Jane. Let's start with the Fed conversation then. Given we were just hearing there from Loretta Mester, inflation is too high, she says. A lot of people would draw the same conclusion looking at the inflation rate and the Fed's target. But what does that actually mean for Fed policy, do you think, in the short and medium term?
Well, of course, you know, the Fed, like other central banks do, that they're in this position whereby they need to sound relatively hawkish because they need to try and manipulate market interest rates to remain relatively high to make sure that they can fight inflation over the medium term. Because for all the central banks, inflation is too high relative to target. But if they allow markets to think, oh, you know, that the Fed's just done its job, then market rates will fall and therefore inflation is more likely to remain above target for longer. So I think it's necessary for them to retain this sort of guidance, this rhetoric that they are still nervous, which they probably still are about the inflation over the medium term, and to allow market rates to remain relatively elevated. So again, that the higher for longer story, I think, is really necessary for the Fed and other central banks too.
Jane, good morning. Does this idea of hawkish rhetoric, is there any exception to it globally? So I know you think that the ECB probably doesn't hike this month. I know you think a hawkish hold from the RBA. Is there any exception to the rule that, hey, central banks are probably near the end of the cycle, you're erring on the side of less hikes than is priced in the market generally, but you still think hawkish rhetoric? Is there any exception to that, or is that universal across G10 central banks?
Well, I mean, the Bank of Japan clearly is not in that camp. I mean, but I think if we take that aside, I think we do have the same sort of issue elsewhere. I mean, I think what's going to be interesting this week is you know, Canada, because they have had weaker than expected growth data for the second quarter. They were one of the first central banks early in the year which highlighted that they were going in for a pause. I mean, that didn't work. They did end up having to hike it eventually. So are they in a position now where they can begin to relax slightly? So their rhetoric is going to be quite interesting. But if we go back even to the RBNZ, they were the very first G10 central bank to be out of the traps with an interest rate hike. And they too are of this view that they are not going to be cutting interest rates for a very long time. So if we take their cue from them, I think that the hawkish rhetoric, that the higher for longer, is a generalization that fits most G10 central banks.
How do we fit higher for longer and what that means for the dollar, Jane? How do we fit that with what we're hearing increasingly from strategists around fixed income? So, I mean, Mark's been talking last week about whether we've seen a peak in the short end rates on treasuries, and we heard from BlackRock about 2 years being a screaming buy. Where does that leave the dollar then? If we continue to hear the strong rhetoric, but lots of people in the markets think that 2-year yields won't go any higher.
You know, I think for one of the issues with respect to the dollar is the prevalence in the market to think about the dollar only in terms of what's going on in the US. I think it's really necessary, if we're looking at the dollar, to think about, well, what's going on in the euro, what's going on in sterling, what's going on in the renminbi, because they really have a huge influence in what happens to the dollar. And I think if we pull out, for instance, euro dollar for now, and I think what's been happening, you know, most of the year we had the market holding very long euro positions, anticipating that the ECB was going to remain very hawkish. That question has been really undermined recently, that there is this perception that it's going to be touch and go whether or not the ECB can hike again. And the market's thinking, well, why are we sitting on such long euro positions when the ECB may be done? And actually, German growth looks really, really weak. Now, we've just revised down our Eurozone growth forecast for both Q3 and Q4. We see now a very mild recession there. And I think that's going to undermine the euro and make euro dollar, probably come down a little bit further. I think, you know, sterling, similar position. I think if we look at China, the weak story there, and wonder, you know, how much weakness is going to influence the rest of Asia because of the weakness in China. I think also you've got a strong dollar story from then. So I think dollar strength is about a lot more than just the US story.
OK, so dollar strength is not really about a particularly strong story. It's about being weak, the alternatives. And I know you've been bearish the euro for some time and you've had this kind of correct, and you think it might potentially have more downside, but we're around towards your target levels. That narrative's played out to some extent. Does this mean that given that you're kind of being forced into a slightly more positive dollar view without being particularly bullish the dollar, does this mean there's much better opportunities in the crosses? And if so, which crosses excite you? Like, is there somewhere else you prefer being short euro rather than short euro dollar from here?
Yeah, you know, I think that's an interesting question. I think we all need to, you know, be wary about the crosses. You know, I think, you know, euro yen is certainly an interesting cross, and I think also if we're looking at you know, Aussie New Zealand, I think that's an interesting cross too. I think Australian fundamentals are really very good in terms of its current account position, its budget position, but you're not going to be buying the Australian dollar against the US dollar in an environment that we have now where it's high risk, with Chinese growth could be weak, but you might be looking at it against, for instance, the New Zealand dollar. So I think there are quite interesting opportunities in many of the cross rates right now.
Can I ask you about the pound, Jane? I was just looking at year to date. It's done pretty well up against most other G10 currencies. It's also done pretty well relative to other currencies over the last month, even if it's also fallen along with many others against the US dollar. So where do we stand on the pound right now?
Well, you know, I think the pound is very interesting. I mean, certainly, I think cable is very different. I think euro sterling is where we get some interest here because, you know, like I've said, we revised down our forecast for the Eurozone for Q3 and for Q4. On Friday, we had that data from the Office of National Statistics in the UK revising up the UK GDP position across the pandemic. So, you know, at the start of the year, I was very much of the view that the pound would fall against the euro during the course of this year. And then I thought, actually, they're much more evenly balanced as we began to get a deterioration in German data. Now I'm beginning to think, actually, yeah, they're still fairly evenly balanced. This is the euro against sterling, but maybe the sterling's got a little bit more here. So rather than end the year with euro sterling higher, maybe we're going to end the year with euro sterling just slightly lower. So I think the sterling data, the UK data, has not been deteriorating relative to German and Eurozone data, perhaps the other way around.
Jane, speaking of sterling and the UK, I feel like I need to ask you about your other EM views out there. Which is your favourite EM currency and which is your least favourite EM currency going into your end?
Well, the one that perhaps I'm most interested in, I think, is the Turkish lira. And no one wants to stand, in front of a moving bus for that one. That's been the case for a very long time. But, we are seeing some changes there. Are we going to get through the local elections in March with, these new policies still in place? And if we do, then, I think that the market's going to turn. So it's a medium-term call, but I think that's going to be, really quite interesting. In terms of, generally, I'm very concerned about China. I'm very concerned about how that is going to impact some of those Asian currencies, particularly those commodities producers. And as you were saying earlier on, for many commodities, we haven't really seen a huge push down in price. I think iron ore certainly comes to mind there. But, I think these are still vulnerable. And I think, in some of these Asian currencies could really underperform on the back of what's going on in China.
Jane, thanks so much for joining us. Jane Foley, Head of FX Strategy at Rabobank. Thanks so much for joining us this morning. Mark, a quick word from you on FX markets then. We saw quite a strong bounce in the dollar on Friday as a result of quite a bit of data coming out of the US economy. Are you feeling positive about the dollar? Are you negative given your short-end Treasury view? Do you share the view that Jane had that a lot of this is being driven by other FX rather than by the dollar per se?
I share a little bit of that latter component. I always think it's important that people can be overly focused on the dollar. I will say I have a different view on the dollar. I think that into year end now, I'd be negative the dollar. That's partially related to my 2-year yield switch last week, but it's also related to the fact that earlier in August, I pointed out that I think dollar yuan has peaked for the year. And I think it's very important for driving that sentiment around the broader dollar index. Now, given that I think 2-year yields have peaked and I think dollar yuan has peaked, at some point that really, unless there's massive cognitive dissonance, implies that I think dollar yen has probably peaked. And that is something I'm really watching for that turn. I think that's the next leg to turn in the broader dollar index. So I am bearish dollar into year end, and I think it could be the start of a bigger move lower in the dollar overall, even though I always agree that you need to look at both sides of the FX cross.
OK, thanks to Mark for his thoughts on FX markets. Yeah, interesting to keep in mind the tone set by the Chinese currency then and what that does to broader sentiment around the dollar. Coming up on the programme, we'll talk about the auto sector. German automakers are facing increased competition from Chinese rivals. We will speak with the head of Germany's auto lobby next. Live from the Munich Auto Show, our colleague Oliver Crook on the ground. We'll get an update for you later in the programme around some of the concept cars being introduced. Some of the focus seems to be on extending the range of some of these luxury vehicles, allowing them to travel further on a single charge. I'm sure that will be positive news to anybody who's ever suffered from that range anxiety. We'll talk about all things auto, that conversation coming up shortly. This is Bloomberg.
The more my company grows, the harder it is to stay focused on our core product. I need to master DE&I, ESG, M&A, even how to adapt to hybrid working. The more hats I wear, the more I need Aon. They bring their whole team to the table and give me access to great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
What we have observed is that larger asset management firms, but also private banks or just general financial institutions have established themselves here in ADGM.
Abu Dhabi gives us capital access, but it also gives us talent access and market access.
So we have access to the private sector, to the public sector, to the policy makers.
Welcome back to Markets Today. 30 minutes from the cash equities open here in Europe. Let's get to your top stories. European futures are higher as the latest US jobs data boosts the case to end Fed tightening. Stocks in Asia rally boosted by Chinese property stocks on bets the latest stimulus measures will bolster the sector. Italy's Deputy Prime Minister tells Bloomberg the country may look to hasten the sale of Monte dei Paschi amid Rome's proposed move to offload some of its holdings. Plus, the race to dominate the global EV market heats up. Both BMW and Mercedes unveiling their latest concept cars aimed squarely at Chinese consumers. We are live from the IAA car show in Munich. Welcome to the programme, everybody. Let's have a look at the futures picture. Remember, we are without our US friends today, so no trading over in the United States. We do have positivity on the European futures picture, up by 0.4%, 0.5% perhaps on FTSE 100 futures. We saw FTSE markets outperforming the rest of Europe during Friday's session. The rest of Europe was negative. The FTSE went higher. That was the commodities sort of standout difference. Once again, maybe we'll see a bit more of that today. We'll focus on that. But the futures picture doesn't look all that different this morning, does it? DAX futures up by 0.3%. Plenty more to come on the auto sector as we go through the programme. That, of course, of great relevance to the German market. Mark, let's think about what has caught your eye this morning. We've talked a lot about China, but you're focused on the Chinese growth story this year and next to give us that slightly longer-term perspective.
Yes, and I want to provide a few facts to the narrative. I feel that the China economic negativity has completely lost the plot, and I need to push back on this idea. I've heard talk of hard landing in China. I think a few things to get clear is that China has some very, very big structural problems, primarily based around its big property bubble and also its shadow banking system. And those two problems are going to remain structural problems for the next couple of years. They are large parts of the economy and they are real. However, they are not the whole economy. So let's get some broader perspective here. First of all, this is the consensus economic forecast for GDP growth of the 4 largest economies in the world. The purple line is Japan, the blue line is the US, the yellow line is Germany in contraction, and that white line way up there is China. Now, the consensus forecast is for China to grow at 5.1% this year. The highest of any of the other 3 major economies is 2% in the US. And I've talked about, I think that that's actually peak optimism and will only go lower from there. But let's run with it. And everyone knows that China one's too high, and really it's probably below 5%. The recent ones are lower. Well, of 74 forecasters on Bloomberg, the lowest estimate is 4.5% for China's growth this year. So if we take the most pessimistic out of 74 people, it's still growing twice as fast as any other major economies in the world. So I think that's the first kind of context. But everyone goes to me, oh, but wait a sec. It's not just about this year. It's also about the fact that it'll be a shock that it's growing so much slower than last year. Last year, China's economy grew at 3%. So it'll be 50% faster than last year, and that's a negative shock. That's much better than any of these economies again. Oh, no, wait, it's not just about last year. It's about the longer-term context. You know what the average growth was in China over the last 3 years? 4.5%. So again, the same as the most pessimistic forecast this year. So I think we've made clear that China's economy is not collapsing this year, despite its big structural problems. Oh, but what about the future? Well, let's roll on and have a look at these same forecasts for 2024. And what we find is, actually, again, the growth differential is meant to widen next year. So China's growth is meant to be much faster than the rest of the world, where most of these other economies are going to struggle for positive growth. And a reminder that Germany will be contracting this year. Again, I've highlighted the most negative forecast of any forecaster out there is 3.7% for next year. Note that only is Japan, thank you much, only Japan is meant to get as high as 1% of the other 3 major economies next year. So next year, according to the most pessimistic forecaster, China will grow almost 4 times as fast as the other 3 major economies in the world. So I think that's enough facts to kind of go, we need a little bit of perspective. There are very real structural problems, and you'd be wrong to deny those structural problems, and those structural problems aren't going away. We're going to be talking about them for the next year or two, but every so often you need to remind people that China's economy is doing fine from an economic perspective, from a growth perspective, from how it feeds into markets. Now, you may say there are social issues with only growing at 4%, and that's maybe a valid argument, but do not talk about hard landing in China. Do not talk about China being a growth laggard. Do not talk about China growing slower than the rest of Europe. My rant is over. I apologise.
OK, I don't think your rant is over. I think you have plenty more rant in you, Mark, so we will not trigger you by talking
know me too well,
about
Anna.
China with a hard landing. But let me push back, or not push back actually at all, but let me add in another thought, and that is around geopolitics, because you've mentioned how we shouldn't be concerned about China growth relative to other economies or relative to last year, but what about relative to its own potential? And I mentioned this because some people might be more focused on sort of self-inflicted wounds through a negative geopolitical backdrop. And I'm not saying that this has an impact this year very visibly yet, perhaps, but maybe in the years ahead, maybe that just weighs on sentiment for a lot of people.
As always, Anna, you found the perfect hole in my argument. It's the great question. You're absolutely right that China is underperforming potential. And that is maybe problematic for what some people have expected. And it's also, as I said, a domestic social issue. And I think that allows me to, again, to reiterate the key message I'm trying to say here. I am not trying to say that China is in some wonderful bullish economic outlook. It has very deep structural problems, and they're not going to be solved this year or next year. This is going to hang over the market for years. All I'm saying is that just when people start being completely doom-mongery and panic-mongery and start going a bit crazy with some of the assertions, just a bit of context that China has been one of the fastest growing economies in the world for many years. It is no longer going to be one of the fastest. India is going to pass it out. Indonesia, Philippines, these other countries in Asia are going to pass it out. But it is still growing much faster than G10 countries. Is that enough to quell the kind of social situation and keep people happy there? Maybe, maybe not. But don't mistake that for kind of thinking that China is anywhere close to a recession or anything like that.
OK, let's bring in another voice. Sam Unstead joins us on set here, Mark, from the Markets Today blog. And Sam, good morning to you. Happy Monday. So, of course, you focus very much on UK stories. We've got plenty of those this morning. But there's always the China handover. There's always the global backdrop to weigh in and to factor in. Your thoughts on this whole conversation around China? I mean, clearly we're seeing some short-term policy initiatives having some short-term market impact overnight.
Yeah, certainly, I think this morning's moves, and, obviously you've got to remember that we had Hong Kong was closed on Friday, so some of that has been is a sort of build-up of 2 days' worth of moves. So, yes, that is feeding into this morning. I think what's interesting about that move, particularly around the property sector, is this is what has been the refrain for so long now with China is these are little moves, like little moves at the margins from authorities to try to boost property, to try to boost the economy. Now it seems like they're all starting to cohere, and that there's at least some element of optimism starting to come back in, that they are starting to feed through and work.
Sam, you're probably too scared by my rant there to get involved in the China economy, so I won't force you on that issue. Jeremy Hunt was in the headlines this weekend, making some big promises about what the UK government can actually achieve this year. Tell us the story there.
Well, I think making... I'm not sure if he's necessarily making a huge promise. He's sort of just observing the trend that's going on, in all honesty, with or without the government. The inflation is likely to go down to 5% by the end of the year. He's talking about that. He's also talking about a policy issue that's really starting to come into focus this week, because schools are going back and schools in the UK are crumbling, a large number of them. And there's it's quite a nice little mirroring there that Parliament also goes back this week, also into a building that is kind of falling apart and needs a lot of work. So a nice story between those two stories there. Nice.
Use that term advisedly.
Nice,
yeah. Nice. Journalistically nice, perhaps, around crumbling schools and crumbling Houses of Parliament. In terms of the focus, though, there is a sort of back to work sense, isn't there? There's always after the summer recess. Tories trailing Labour in polls with the election expected in 2024. So far, so we knew that, didn't we, through the summer. How are things moving forward in the sort of political narrative here in the UK?
Well, I think particularly this month there's going to be a lot of focus, and certainly for us as well, there's a lot of focus on the Bank of England. Andrew Bailey is going to be grilled this week by the Treasury Committee. That'll be an interesting comeback from a holiday as well. A lot of talk we would expect there, a lot of quizzing around high wage growth, and with Jeremy Hunt talking at the weekend about inflation, that will likely figure into that quite a bit over the course of the week too. But I think the economy is going to be very much at the centre of everything, certainly for September, and once we've got past the next Bank of England decision.
OK.
Sam, the ARM IPO roadshow has begun. This is like the most hotly anticipated IPO that I ever remember. That might be because my memory is short, but I don't think it is. Tell us, what's going on? What's your view?
No, I think I agree with you, Mark. I think it was certainly for a long time. This has got so much attention. It's got a lot of attention over in the UK because there's this sort of sense that the UK has lost out on this. I, in all honesty, don't know if the UK was ever really in the market to win the ARM IPO listing. What we got this morning is that they're scaling back a little bit in terms of valuation, how much money they're going to raise. The market, the IPO market is still not particularly strong, so I think that's probably a sensible thing to do. But it's still going to be an enormous listing and still going to take up a lot of attention, and quite rightly, because it is it is also a story about the US market and the valuation that you can get in the US market for an AI-focused chip maker in comparison to what you were able to get in London.
Sam, thanks very much. Sam Unster from our Markets Today blog. You can get more on all of these stories. Go to the Bloomberg UK website. You can click through from there into the Markets Today blog, or you can go to TLIV Go on the Bloomberg terminal. That will also take you to the blog for every working day here in London. Now, coming up on the programme, Novo Nordisk is launching its weight loss injection, Wegovy, in the UK today. That is according to various reports. We will get a focus on that and the other stocks to watch next. This is Bloomberg.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
Welcome back to Markets Today. We are 17 minutes away from the start of cash equities trading here in Europe. Of course, it's a public holiday in the United States, so no trading in the US. But expectations in the futures market are for a little bit of a bounce at the start of trade today, perhaps to do with the China read across, positivity coming through on the Chinese economy, at least in the very short term, surrounding the property sector. But also expectations of maybe solidifying around the thought that the Fed will pause, and so that leaving some space for risk assets to go a little higher this morning. Let's get to some breaking news coming through on the Bloomberg terminal, and this concerns the tech business in China, Huawei. We have some analysis here at Bloomberg that shows Huawei and China's top chip maker, this is SMIC, have built an advanced 7-nanometer processor to power its latest smartphone. The smartphone is the Huawei Mate 60 Pro. It's powered by a Kirin 9000 chip, and the reason that this is important, it shows that the Chinese government is making some headway in its attempts to build a domestic chip ecosystem to try and reduce the impact of some of the sanctions, the US and other sanction efforts that have gone against China and specifically against Huawei. So the Chinese government are using other tools to try and produce these chips domestically to build up the strength of that domestic business. So that is the Chinese tech story of the moment, just breaking across the Bloomberg terminal this morning. Let's turn to the auto sector in Germany. Mercedes has unveiled an electric concept car with a longer range than any Tesla model on the market. The German luxury brand is using the Munich Auto Show to ramp up its challenge to Elon Musk's EV market leader. The Mercedes CEO tells Bloomberg the company focused on serving its customers.
Our goal is value over volume. So we're not pushing volume. We're very, very careful about how we go to market, our go-to-market strategy. And as you can see from the results for the first 6 months of this year, that has been working quite well for us.
And can you continue to ignore Tesla's price cuts even on the higher end, which are more in competition with Mercedes products?
We're focused on value for the customer. I don't think the customer expects from a Mercedes a little bit of a roller coaster ride, but something that you can depend on. So we will continue with the value over volume strategy.
And there's huge concern about the state of the Chinese economy. What is Mercedes' experience of the Chinese economy right now? Is it affecting demand?
I think we have to take a little bit of a cautious stance on that and see how things develop and not expect rapid growth as far as the economy is concerned in the short term.
This car show will also be marked by a lot of Chinese automakers bringing their cars to the market, introducing them maybe for the first time to many people. How do you view that in your home turf here in Germany?
The auto industry is in transformation. I think almost a disruption. It's natural that new players are going to come in, and we respect both the established competition as well as new players that are trying their luck in the business. But that's not our focus. Our focus is on the Mercedes customer, to give that customer the perfect blend between technology and desirability.
And that customer loves the G-Wagon, and I have to ask now about, is this a lowercase G? What can we expect from your announcement today?
The G-Wagon is an icon. I mean, it's almost impossible to get one, actually. It's sold out. But yes, tonight we are announcing for all the G fans out there, there will be a little G. So a son or daughter of the iconic Big G. We have not announced timing yet, but if you wait for something good, it will be worth the wait.
Well, there's the tease for you. There's the Mercedes CEO, Ola Källenius, speaking to Bloomberg, speaking to our colleague Oliver Crook, in fact, at the Munich Auto Show. Bloomberg's Germany correspondent joins us now. Oliver, really fascinating conversation there. He certainly let you know that something is coming, dropping some big hints there. What about the European showing at this auto show? What are the key messages you're taking away from the European automakers?
That's right, Anna. Really, the takeaway here is that we're at ground zero of Battle of the BEV, battery electric vehicles, and everybody's coming out with their concept cars, BMW, Mercedes, as you saw there. But these are really cars that are a couple of years out in the making, you know, so everybody's showing off their technology here. But really, it's a lot of the Chinese car makers that they're fending off, that they're really playing a bit of defense on their home market and really trying to put a vision forward for what these EVs look like going forward, and whether or not that they can continue to dominate this market. And of course, it's not made any easier by the fact that just on Friday, Tesla came out with their new revamped Model 3, in addition to the fact that they continue to slash prices just across the board. So there is a lot of pressure mounting here in Munich.
Oliver, let me ask you about the China story then, because you mentioned on the competitive front, they're fending off perhaps Chinese competition. They're also trying to sell into China of their own accord. What are the China themes that are landing there in Munich?
Yeah, so you've got the sort of two edges of that sword, where on the one hand you have that slowdown in China. You know, we speak to the CEOs there. They do not expect that market to come back in the way that it has historically, and that maybe, as Ola Källenius said, the kind of explosive growth rate of China is come to a close for a while time. They have to deal with these structural problems. That's one side of it. The other side of it is many of these brands like BYD, which has basically toppled Volkswagen as the biggest brand in China, is now really introducing itself to the international markets and in Europe for the very first time. So for them, BYD, NIO, Zeekr, Xiaopeng, they're all here to really show their product to the European audience, for many people for the very first time, and that is really what is putting a long-term pressure on the automakers. You look at these legacy automakers, you look at the valuations, and you can see the pressure right there.
Yeah, and you wonder if there is perhaps room for them in Europe, given what we were hearing from the Mercedes boss there about not being able to get hold of some cars because they're all sold out. Thanks to our Germany correspondent, Oliver Crook, of course, on the ground for us at the Munich Auto Show. Plenty more to come from Oliver in the second hour of this programme, in fact. He'll be bringing us some key interviews. Let's get the stocks to watch this morning. Joe Easton joins us from our equities team. Joe, good morning. Let us talk about Italian banks, shall we?
Morning, Anna. So the Italian Foreign Minister Antonio Tajani said at the weekend that the Italian state could be looking to sell down its stake in Banca Monte dei Paschi quicker than previously expected. This follows reports last week that the state could be looking to sell shares in a number of Italian companies in order to reduce debt and also pay for some potential tax cuts. Tajani was speaking to our colleague Francine Lacroix. Have a listen to what he had to say.
Probably yes, I am in favor, my party is in favor of the privatization, not only the Monte Paschi Bank. Is for have more money for the state in our budget. We need to work in this direction. The debate is open. We need to decide in which sector we need to achieve these results.
That was the Italian Foreign Minister Antonio Tajani speaking to Francine Lacroix there. In terms of what Paschi's shares have done recently, has actually recovered a bit from that sell-off spurred by worries about an increased Italian